if you think about it, it'll just be the whole situation that we've had in the past decade where every money has just kind of continually moved into the US. It'll then just move out. And I don't think it'll move out in some sort of crash scenario where all of a
Yeah.
sudden everyone leaves unless there's something really dramatic that Trump does. It'll just be at the margin. It'll be more and more money coming out and forcing this thing out. And so we're going to see years of underperformance of the US stock market.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. There's a lot of urgency right now in America to reduce the fiscal deficit via the new Department of Government Efficiency and to also reduce its trade deficit via the threat of tariffs. Both initiatives are creating a lot of disruption right now and have their fair share of vocal supporters and detractors. So, are they likely to work? And at what cost? To discuss, we're fortunate to speak today with market veteran Kevin Muir, founder and editor of the Macro Tourist, the highly acclaimed newsletter that currently ranks as one of the top financial Substacks in the entire world. Kevin, thanks so much for joining us today.
Adam, it's always a pleasure to be on your show. Thanks for having me.
Thank you. And I appreciate you bringing such a great attitude when, there's a little uncharacteristic tension between our countries right now, you being in Canada, us being here in America. But we love you guys and very
Yeah.
much love you, Kevin.
Listen, Americans are terrific people, and I'm sure we'll all work it out, and eventually we'll figure it all out. And I realize that's just one person talking, and the vast majority of people have a much different attitude.
Yeah, great. Well, and there's been our president, has been talking with some colorful language about maybe referring to Canada as the 51st state, and I've now seen Canadians starting to refer to the U.S. as the 11th province.
Well,
So I thought that was good turnaround.
so Adam, I was going to say I can forgive you as long as we beat you in hockey. And then that was the key. So I would have been a lot more upset if we had lost in hockey than anything else.
All right, and let me say congratulations. You guys played a great game. So, anyways, yes, I'm glad that we can all stay friends through all this. All right, well, look, you mentioned the intro there that there's a lot of focus right now on reducing those twin tariffs. I know that you've been writing about this. We'll talk about that in a second. Real quick, let's just kick it off with the usual general starting point, Kevin. What's your current assessment of the global economy and financial markets?
Well, I've been saying this for a bit, ever since Trump was elected, that the world is changing. It's changing in a big way. And one of the things that I've been highlighting is that we're returning to kind of the environment of the 1980s when those macro gurus, the hedge fund, kind of pioneers like Soros and Steinhardt were making their fortunes trading big picture, kind of asset classes. And I suspect that that's about what we're about to embark on. And I think we've already seen it in terms of the various moves that we've had. All you have to do is look at the kind of relative moves on the stock markets of the last month or two to see the fact that now all of a sudden it's not just the US going up. We see things like European stocks screaming, and then we see stuff like the dollar getting traded in a big way, or gold going to new all-time highs. These are all asset class moves that we're going to experience going forward that's going to continue. And I've been kind of harking and just drilling this into people's head that in the past, it was easy to kind of not worry about macro. A lot of the economies were, basically intertwined. There was not a lot of conflict. There was not a lot of worries about that.
Right. Well,
And
you said to buy long and sit on your hands and just
that's
hold.
right. But more than that, the policy of the different countries were, there's a spirit of cooperation. There was no sorts of conflict between them on terms of economic policy. Sure, there, at the margin, you might have seen something where someone was slightly more easy or someone was a little more letting their currency go. But it wasn't these sorts of really distorted markets that we're seeing now in terms of, people being very upset about the price of their currency or the level of rates. And I suspect that what we're going to see going forward is much more of this. And I really caution everyone, go out if you haven't been spending any time on macro in the last little while. get yourself up to speed because it's going to matter more and more.
Okay. I want to note that your point there about the stability of the past couple of decades, where most of the global players were kind of locking arms and working together, globalism more or less. Um, that era seems to be ending, being replaced with, well, what Michael Every, who I just interviewed, had a really long, fascinating interview with, calls it's more of a return to mercantilism, nationalism,
Yep.
sometimes manifests as protectionism, which Michael basically says that's the way it's been for centuries. And to give him credit, he was predicting for many, many years that there was going to be a return to that. And it seems that that's all of a sudden, really started to happen in recent years and now gone on steroids now that a guy like Trump is now back in the reins in America here. So, anyways, my point is there are other smart macro analysts that are singing a similar tune right now to you, Kevin. So when multiple smart people say the same thing, I always think you should perk up your ears and listen a little bit closer. Okay, so you're expecting macro to matter a lot more, some pretty big seismic changes going
Mhm.
on. You want to make sure that you are paying attention so you can be on the right side of those changes rather than getting steamrolled by them.
Yep.
Okay, we'll talk in a moment about uh, some of the other big trends that you see and maybe some of the ways that you are looking at playing for them. But one of the trends that I know that you've been looking at, because you sent me a list of a couple of trends that you're spending time looking at right now, is what's going on with the deficit, the focus that's going on there with these
Yep.
twin deficits. And specifically, I believe you think that there's maybe a lot that people are getting wrong right now about the current approach to reducing these deficits. So, how are you looking at this?
Okay. First of all, uh, when I say people are getting it wrong, too many people are too busy trying to say what's best for the economy or best for the long run society. And we as traders, we shouldn't care about that. Like, yes, we can, as citizens, we should be deciding that. But we as traders need to be kind of just cold, hard, analytical, looking at things, saying, I don't care whether this is right or wrong, whether I agree with it or don't agree with it, whether I think this is best for our society or not. This is what's happening. And therefore, this is what's going to occur in terms of the stock market, in terms of asset returns. So I just want to kind of put that right out there right away, because too often people will hear what I'm about to say and they'll say, but wait, no, that's not going to, that's not important, because the reality is we need to get our deficit down, because then we're going to leave a huge deficit to our children, blah, 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 blah. I don't disagree, and I don't really care, and I don't want to discuss it in terms of like making an argument about it, because ultimately what that decision is something for us as citizens. It's not something as us as traders. And so, what I want to focus on here is, let's just start with the fiscal deficit. I think that's the easiest one. So, the fiscal deficit is the amount the government, takes in as revenue versus how much they spend. And a lot of people have this inherent bias towards thinking that a fiscal deficit is bad. Like, they hear, oh, deficit, it must be bad. And
Right.
Adam, you and I run a deficit for too long. We ultimately can't pay it off, and it is bad, and we will go bankrupt if we spend too much, versus what we're taking in. Government is much different. And one of the things that, we could debate whether in the long run how it's going to work in terms of whether it needs to be paid off and all that stuff, but that doesn't really even matter either, because over the short run, or the short to medium run, there's no doubt that a fiscal deficit is positive for the economy, and it is positive for the stock market. And all you need to do is think about an accounting identity, which is the government's deficit is the private sector's credit. And I know that kind of, it seems simple, but and too many people think, oh, the government's spending this money, it must be gone. Well, no, it's not gone. It's in our genes. Like, it's
Mhm.
you and I have it, whether it's, us getting direct money from the government, or us getting taxed less, or the government spending it, building roads or putting in new chip plants. Either way, that's all creating economic activity. And so, one of the things that a lot of people miss in terms of the reason for the American outperformance in terms of their financial markets of the last few years is that they've run you guys have run the largest deficit in the world in terms of out of developed countries. And all you have to do is look at the COVID response. Your COVID response as a percent of GDP was 25%. The next closest was Australia at 18. Canada was 16. A whole bunch of the Europeans were at 15. And so one of the things that I say that the American economy's done much better, and I'm like, no, no crap. It's done so much better because there's been so much more money put into it. The stimulus has occurred. Okay. And all you have to do is look at it's not just the post-COVID period. Even right now, the government is running in the US a 7% deficit. And people think, oh, the rest of the world, if you didn't know better, you'd think the rest of the world is around the same. Well, in Canada, we're 2%. In Europe, we're 3. In Japan, it's 2. So the reality is that the US has been in this extremely accommodative fiscal stance. And that is part of the reason that the economy has done so well. Now, whether it's sustainable or whether it's the best thing for the long run, it doesn't matter. That is why the stocks have done so well. That money has gone directly into the profits of all these corporations. So I look at what's happening now with the Doge and with Trump pulling back on that deficit. And I say, listen, that very well might be the best thing for the US economy over the long run. But over the short run, it's going to mean an economic slowdown. And I'm kind of just perplexed at the amount of people that I've just refused to accept that. And to some extent, Adam, I think this is kind of like March 2020 in reverse. And if you remember back in March 2020, we were going into COVID, and a lot of people were very convinced that the economy and the stock market was about to fall off a cliff. And I kept saying, no, you know what? If the government steps up and spends enough, they can fill that economic hole. And sure enough, that's what happened. And it ended up being that they spent way too much. We created inflation, and I'm not going to dispute that in the least. But at the same time, there's no debating that at that time it was wrong to be bearish. Now, fast forward to, February of 2025, and we have a government that's doing the opposite. They're pulling back on their spending. They're pulling back on the amount of stimulus that they're putting into the economy. And
Right.
yet,
While everyone still thinks the party's going to keep going.
that's correct. And the funny thing about it is, let's just think about like the equity risk premium, which I think is this amazing statistic one. We'll just use basically the earnings yield of the S&P 500. In March of 2020, the S&P had an earnings yield of like 6.5%, meaning, like that's what they were expecting to earn in terms of going forward. And yet the 10-year was 0.5 or something. So it had an equity risk premium of 6%, meaning that you got an extra 6% by buying equities. Yet what was everyone doing at that time? They were all selling equities and buying bonds. Now let's fast forward to today. The earnings yield on the S&P 500 is 4.5, and yet the 10-year is 4.5. So the equity risk premium has gone from 6 to 0, one of the lowest that we've had in longest time, and yet everyone's bullish now. Like we're trading now at 22, 23 times next year's earnings in the S&P, and everyone is falling all over themselves bullish. And this is at a point when the government is telling you that they're going to pull back on their stimulus with the fiscal. So I think one of the big, big mistakes that people are making is they're still too caught up in the monetary stimulus. They're still too caught up on interest rates. And yes, I do agree that as the spending comes down, the long rates are going to come down, and we're going to get a situation where there will be able to be more private sector credit creation. And I'm not going to dispute that at all. And if you go look at Scott Bessent, the Treasury Secretary, he's taking a page out of the Robert Rubin, which was the Clinton's Treasury Secretary in the late 90s, who came in there and he said, listen, you know what we need to do? We need to cut back on spending. We need to cut back on spending. And when that happens, we're going to have a situation where interest rates will come down and then the whole economy will take off. The problem with that, Adam, is that in 1995, when Robert Rubin came, we had inflation that was very similar. It was almost 3%. And yet the 10-year was 7.5. The 2-year was 7.5. The 10-year term premium was 2.5, almost 3%. Today we have a situation where the 2 years, I think it's sub four or somewhere around there. 10 years are 4.5, and the term premium is 0.6, like 60 basis points. So yes, there will be some benefits to them cutting back on spending, and you might get the long end going down, but it's not going to have the same effect. It's not going to be as powerful of it as it was in the kind of Robert Rubin time. And the fiscal kind of drag from all of this, cutting back on spending is going to be much more important than the kind of increases from the private sector credit creation.
Okay, so let's take that just to the next logical step. So, um, financial assets, especially stocks, especially growth stocks, especially the Magnificent Seven, have benefited from this higher degree of fiscal deficit spending. We got a new sheriff in town. He's going to start turning the spigot off. Maybe not necessarily off, but at least he's diminishing the flow that's coming out of the spigot.
Right.
And you're basically just saying, look, that is going to reduce the boosting effect that it has on those assets. And yeah, there'll be some benefits from lower rates, but it's not going to be enough. Net, it's still going to be a decrease. And so therefore, the whole so what of all this is that means lower asset prices, correct?
Correct. And the slower economy, more importantly. And this is at a time when everyone's expecting the economy to reaccelerate. Let's just rewind back to 2023 at the beginning. I think I saw something. Goldman Sachs has this conference that they have at the beginning of every year, and they talk about the U.S. They do a survey about the U.S. and these are institutional clients saying, what are the chances, or what do you believe are the odds? Or sorry, let me just think about how they word this. I think they just ask, do you think the U.S. will be the best performing stock market in the coming year? Okay, so they ask this sort of, in general, are you bullish or are you bearish? And in 2023, after that terrible 2022 period, remember we had the kind of that huge sell
Yeah.
off. I think 18% of people thought the U.S. stock market was going to do well. So this
Mhm.
is 2023, at the beginning, January 2023. Now, they've been doing this for a decade or so. And I think that up until this point, the top survey response was like 35% or 40%. Okay. So it went between 18 and 35 or 40%. Well, guess what it was in January of 2025? It's almost 60%,
Okay.
meaning
Yeah.
that we have completely flipped after 2 years of this huge outperformance in the US in terms of, we've just rallied 20% each year for the past 2 years, and everyone is super bearish and now all of a sudden they're super bullish. And it's very difficult. And this is one of the hardest parts about trading is that you want to do stuff that's with the majority. You want to go and invest with everybody else because it feels good. But the reality is that the better it feels that way, the more likely it is that the trade is over and you should be going the other way. I always say the hard trade is often the right trade. And to me, the hard trade right now is to be bearish on US equities.
All right. That's a great pithy way to say it. Um, Kevin, let me just ask you this. So obviously, investing, there's a lot of smart people in there, right? It's in theory a very efficient market, but sentiment plays a massive driver, right? So human emotions, human behavior,
Yeah.
right? So is this just being driven purely by recency bias, right? Or like, are there compelling arguments, which I guess you don't believe because you think now's the time to start being bearish, but are there any credible arguments for a three-peat for another year of 20%
Well,
returns?
so here's what it would take for me to be bullish. And I'm not, a great trader never says never. So it's not like I'm saying for sure we're going to go down. But if you told me that Trump was going to continue to run deficits, wasn't going to worry about the trade deficit, was going to not, bother with tariffs and things like that, and was just going to continue with the policies that have traditionally caused the stock market to go up, then I would be like, yeah, we could continue on. Like there's nothing stopping it. But
Yeah,
I
but
just
that
think
would be a contrarian Trump bet. Like he's not arguing for any of those things right now. So
correct.
the
That's
majority of
why,
the market can't be taking. It's probably not taking a
yeah.
contrarian Trump bet right now, right? Yeah.
So I'll tell you, there's like a very famous strategist, and I wasn't at this, but someone told me that they went to a conference, and he said, "I am the most bullish that I have ever been in my career," and this was in the initial days post Trump. And I
Mhm.
think that everyone was just so excited about Trump, and they were so excited about the possibility of them cutting all this waste. And I'm fine. I'm not going to make a judgment of whether the waste should be cut or not. I'm just saying if they cut the waste and they just gave it back to people in the form of refunds, or if they spent it in terms of, building roads, or if they, sent everyone checks, then I would be like, okay, that's great. It's just, a reordering in terms of the macro environment.
Right.
But that's not what's happening. He's telling you that he wants to reduce the deficit. And too many people are just underestimating the power of fiscal. And that is ultimately what I believe is that the power of fiscal is getting underestimated. It was underestimated in March of 2020. It's getting underestimated again. And here I'll just give you another kind of interesting development, and this brings me back to the how the world is changing within this Trump world and how macro is going to mean more and more. Uh, with Trump's more adversarial relationships with other countries,
Hmm.
many of them that have previously been focused on balancing budgets and have focused on trying to keep their, spending in check are now faced with an existential threat and that they have to go out and spend. So when I look at what's happening in the world, I see a situation where the US was at 7% of deficit to GDP, on its way to 3, maybe even sub 3. Who knows? We'll see. Then I look at Canada, 2%. Well, guess what? All of a sudden, our main partner wants to tariff us. We have to spend a lot to get infrastructure so that we can get our oil to sell it to other people. We are now all of a sudden in an environment where we need to spend. We have no choice. Like it is ultimately, it's like for us, for our economy, for our livelihoods, we need to spend. So we're going to go from 2% to 5 to 7. Maybe we're going to be the same as you guys, and we're going to be spending on infrastructure. Same with Europe. Europe is going to go from 2-3%. We're going to see a situation where Germany, who used to, by the way, balance their budget, like try to balance their budget. And I always say to these people that love balanced budgets, I go, well, if they were so great, why weren't you buying German stocks? Like if balancing a budget is all that matters for a stock market, and if that is the driving force, then why aren't you owning German stocks? And
Right.
the reality is that that's not how the world works, and it's definitely not how the stock market works. So we're going to see a situation where Europe, Germany is going to go and they're going to start spending. And I think that the market, in terms of this outperformance that we've seen over the last kind of couple of weeks in Europe, is that it's the market starting to figure that out. Take China, for example, another good one. China, they haven't yet gone and done their true stimulus. Like everyone was so disappointed in the stimulus. Remember, we had that big Tepper moment. He got on CNBC. He said, "This is it. They're going to spend," and then everyone rushed into the Chinese stock market, and then it kind of rolled back over. And
Yeah.
yes, over the last month, we've had a rally in some of the tech names, but on the whole, we still haven't had the big Chinese stimulus. And the reason for that is they've been on their, New Year break, whatever it is, in terms of they all take time off for the new year. And then they have this People's Republic Congress, and that's in early March. And when you go look at a lot of these policies that are the actual the policies of stimulation in terms of spending, they're all going to be instituted in March. So we still haven't seen the extent of the true Chinese stimulus. I think to some extent, it's also going to matter in terms of how aggressive Trump is. But again, they are going to have no choice but to stimulate, because the reality is that Trump has made it so they have to go and spend. They have to rely on more of their own internal demand. So, what I see happening here is the rest of the world taking a more easy fiscal stance, and the US taking a tighter fiscal stance. So, therefore, I suspect that what will occur if this continues is that the US stock market will underperform all those other stock markets. Not only that, you also have a huge valuation tailwind at your back. The
Right.
US is trading 22 times, next year's earnings. Stuff like Europe is 14, right? China's 12.
Right. No, and nobody wants to touch emerging markets. Yeah,
Right.
exactly.
So that's how I see the world in terms of fiscal. I think that the world continues to underestimate its power and how much it's going to drive different trades.
Okay. So this trade, and I've had a couple of folks on the channel relatively recently, not making that exact same case the way you made it, but kind of making the case, uh, price is what you pay, value is what you get.
Yeah,
And at some price, at some low price, uh, formerly unattractive investments start to become attractive because they're just really deep value. And they're like, if you look around at a lot of the rest of the world, capital has been flowing into the US markets so much that you're really getting some deep discounts in the rest of the world. So you're saying, okay, you've got that valuation opportunity there, that imbalance, and then you have the fiscal
the
tide shifting.
catalyst the catalyst is the fiscal change
Right,
that was forced upon them from Trump's policies.
right, which will
And
act sort of like stimuluses to their economies and their stock market that
correct,
it did here in the US, right? So there'll be a
correct.
dawning of, hey, wait a minute, that's where the action's going to be. And by the way, the price is really good right now. And so do you expect to see capital flows out from the US back to the rest of the world?
Yes, and that's one of the other things about this is that the US is massively overowned. The currency is massively expensive, I guess is the easiest way to say it. So everyone owns too much of the US because let's face it, over the last kind of 10, 15 years, it's been the only place to be. If you were a European pension plan and you didn't have extra, US stocks, you're fired. You don't have a job. And so it's one of these situations where it's kind of career risk has forced everyone to be extra long the US. And now all of a sudden we have this catalyst that's going to cause this change. And one of the things that I've always argued is people say, well, you can't invest in Europe. It's so bad. And they talk about all the bureaucracy and everything. And they're like, why would anyone do that? And I say, all you need is a move back to benchmark and the move will be huge, meaning that the weighting of if just the European pension plan goes back to the US being X percent of their,
Mhm.
they take off that extra weighting of the US and bring it back home, it's going to be monstrous. And especially in Japan and China. And that's the other thing that I think is interesting is that everyone talks about this desire to own US assets like it's something that will always be there. And I think that they forget that the US is a net debtor nation. They
Mhm.
forget who has the money. And so I see all these folks very excited about what Trump is doing to China. And I'm like, okay, like that's fine. But let's not forget, China's the one that owns the US bonds. It's not the other way around.
Yeah, they're the one with the surplus. Yeah.
Right. And so I think I think it's very interesting how many people forget that part of it because the reality is the US has been willing to run the largest deficits for the longest time. So money has been attracted to the US. And therefore, we've kind of taken it for granted. But if Trump is now saying, no, we're not going to do this fiscal deficit forever, we're going to pull this back, it's going to change. And then the other thing is, Adam, we haven't even started to talk about the trade deficit.
Right, right. We are just about to get there. But real quick before we do,
Okay.
because I think Trump would say, where he end this conversation, hey, Kevin, don't worry, because we're going to be getting all this money from the tariffs that's going to offset this reduction in liquidity from the fiscal reduction. But before we get there, um, what do you think is the time? What kind of like time window do you put on this reversal of capital from the U.S. to the rest of the world? Is it something you think is is going to happen pretty quickly, like within a quarter, and then it's sort of equilibrated? Is this the next 2, 3 years? Sort of, what are your expectations here?
So you have to tell me as well what Trump's fiscal stance will be. And so we're guessing, right? We don't
Yeah.
really know whether what sort of deficit he's going to run. The reality is he might do some monster tax cut, and then that'll change the whole equation. But if he were to do what Scott Bessent, his Treasury Secretary, is aiming for, which is a move down to 3%, then I suspect that this will be something that will occur, as long as they're continuing down that road. It's gonna be something where it leaks. Like, if you think about it, it'll just be the whole situation that we've had in the past decade, where every money has just kind of continually moved into the U.S. It'll then just move out. And I don't think it'll move out in some sort of crash scenario where all of a
Yeah.
sudden everyone leaves, unless there's something really dramatic that Trump does. It'll just be at the margin. It'll be more and more money coming out and forcing this thing out. And so we're going to see years of underperformance of the US stock market. Ultimately, someone asked me the other day, what would it take you to get bullish? And I said, well, maybe at 12 times earnings. And so, like, that's 10 turns lower on the S&P 500. It's a long way down. And I just don't see why you're going to, if we have a change in the fundamentals that have driven the bull market and they've reversed, I don't see why you should do anything except just, take advantage of it the other way and let it play out just like you should have been letting it play out on the positive side.
Okay. All right. So you think this will be an ongoing process versus an event if things play out the way that you think
Yeah.
they will?
The only thing I will jump in there and say is if there was a massive US dollar revaluation, there could, we could have a forced kind of event that causes it to accelerate. Or if all of a sudden Trump did something really crazy, like let's just imagine he did invade Greenland, then all of a sudden all bets are off. Because I think everyone would be like, no, I'm going to get money back to the U.S. Or let's say he went and he did something like they did to Russia. They did where he zeroed some of Chinese holdings. Then that would be a big deal. Now, I'll just tell you a quick story, Adam. I was in New York and I was speaking at a conference, and I was lucky enough to be sitting beside John Hilsenrath, who used to be the Wall Street whisperer, the Fed whisperer for the Wall Street Journal.
Okay.
And he said this thing, and everyone just went like aghast. And he said, I could see a situation where Donald Trump threatens to not pay interest to the Chinese. And I was like, yeah, I could completely see that. And everyone was just taken aghast, like that would constitute a default, and it would cause huge problems in the financial markets. And I was like, this, have you not been listening? He's been willing to do some crazy stuff. And so this was the fellow that has, specialized in watching the Fed and watching politics, saying out loud that, like, he's like, I'm not sure he would actually not pay, he said, but I could see him threatening it.
Hmm.
And I could completely see something like that as well. So when you ask me about the timing, I would say if kind of as long as it doesn't get a lot worse in terms of these threats and these things he does, then it just kind of leaks out. If it's just a situation where the rest of the world ends up spending a little bit more, US spends a little less, it just leaks out. But it could accelerate in an event where something truly just kind of dramatic happens like that.
Totally get it. And just to summarize, I will say your base case is the leakage.
Right.
But Kevin, if something dramatic happens that makes you think it's going to be more like an event, obviously we'll have you back on the channel here, and
Okay.
you can call audibles on this channel as often as you like. All right. So last question on this before we get to the trade side.
Okay.
So there's a a meme photo I've created. I don't have it handy here, but it's a elephant balancing atop a beach ball.
Yep.
And the elephant was global capital. The beach ball was the U.S. equity markets, right? So as we've just
Right.
been talking about, capital from around the world has been flooding into the U.S. for years. And then the beach ball is supported by these few ants, right, that are holding
Okay.
up the ball and the elephant, right? And I labeled the ants the Mag 7, right?
Right.
Because we have this hyper concentrated market, there's very few stocks, right? So what you're basically saying is that that process is going to start going into reverse,
Right.
right? So what kind of scale correction could you? Yeah, I'm not looking for a hard prediction, but like, valuations will have to come down, right? So I mean,
Yeah.
what are you talking about here? Is this like we could be flat for a decade and be a lost decade, or like this could be like a third of the market goes away or half the market or whatever?
Oh, for sure. Let me just pull it up here. I'm going to go and I'm going to pull up the earnings because I think it's on the S&P. I thought it was interesting. If you go look at the strategists out there, most of them are around like, for next year's earnings or next year's target, they're all around 6,000, 6,500, somewhere around there on the S&P 500. And we're currently 59, 55. And then there's one guy, this BCA guy, and he's at 4,700. And everyone's like, how the heck is he going to be at 4,700? That's crazy, right? And so one of the things that I do this little exercise, if you go look at the S&P 500 earnings, and let's just go back to 2020, it earned, and I'm going to just use the forward 12-month rolling, EPS because that's the easiest one to do, kind of keep constant. It was 178 bucks. It's now 275. So it's added $100 of earnings. Okay.
Mhm.
But even in 2022, it was almost 240 and it declined to 220. So it lost 10%. Okay. And that wasn't even a recession, right?
Yep.
That was just like a slight slowdown. So we're 275. So let's just imagine we go and let's just take off 10%. So what's that? 25 bucks. So we go to 250
You get like
bucks.
to 250, yeah.
Right. Okay. Now, then we go and we say to ourselves, well, what should we be paying for that? And if we go look at history and we go look over time, if you think about it, we're now at one of the most expensive periods in terms of what people are paying for the S&P 500. It was
Yep.
more in 2000 in the dot-com bubble. It got up to 20, where are we here? 24, but we're basically at 22. But if you look through history, you'll see that from 2005 or 2004 all the way to 2020, it went between 18 and 12. So let's just take, 15, right? Given
Mhm.
that interest rates are higher, we're going to get a decline. So if we take 15 and let's just go and let's pull up a calculator here. Let me just pull it up. If we go $250 times a 15 multiple gets you 37.50. Right? So what's that decline? 59.55 minus 37.50, 2,200 bucks on 5,900 is 37%.
Yeah.
And like to me, that's not that's not an end of the world scenario. That's just return to normal. Right? Like that's a regular earnings correction with a multiple brings it back into the standard rate of the multiple that we've been
Right.
at.
To a mean. Brings it to a
Yeah.
mean, not to any extreme
Like I'm
range.
not taking it to
Exactly.
12. Like literally in 2005, we got down to 10 and sub 10. And I'm not even doing that. I'm taking it to 15. So this is my point. This market has got a lot more risk in it than people realize. And it's just that it's gone up forever. And so, everyone just is kind of being lulled into thinking that this is great. And you touched upon the concentration of the Mag 7. I recently stumbled upon this study by Goldman Sachs again that showed the concentration and shows that we are more concentrated now than any time since 1929. And if you go look at the other times that we were this concentrated, it was 1929, like 1972 with the Nifty 50,
Mhm.
2000. These were all periods that it was terrible to own stocks. So a concentration risk that is that concentrated is terrible. And that's the other thing, Adam, that I don't think enough people understand. If you went and asked most people that just own the spies, because Warren Buffett has told them invest in America, you can own the spies. And then you ask them how much of the Mag 7 they own, they would go 7 stocks and they would probably just, put an equal weight on each stock. And so they would think it's a very limited amount. They would never in a million years imagine that they owned almost 40% or whatever the
Yeah.
number is in those Mag 7s. So I think that there's all sorts of risk out there in a myriad of different ways. And it's tough because you end up being this guy that's talking about all the problems, and it's not like I'm a perma bear. I was really bullish, like, and I remember 2022 I was bullish. I was sitting here trying to tell everyone that fiscal was more important, and that the Biden's IRA was going to end up keeping the economy bid for longer than everyone expected. And everyone back then told me I didn't understand. I didn't understand how bad the economy was. I didn't understand all this. And now we're sitting there and everything's in reverse. And I just feel like I'm one of the few that's sitting here saying this is a very dangerous market, and people are the most bullish at the worst time.
You're making me think of that Will Ferrell clip from Zoolander. I feel like I'm taking crazy pills.
Yeah.
Uh,
Yeah.
all right, which is meaningful, because I mean there's a reason why you've got one of the top finance Substacks in the world. I mean you're a very thoughtful, very successful investor. So when you're worried, other people should be taking that seriously. All right, so I do want to get to how you're positioning given these concerns, but we haven't done justice yet to the trade deficit part. So
Right.
why don't I let you get to there?
Okay. So the trade deficit is another part of this kind of equation that has gotten me extremely bearish. And if you kind of think about the agreement, the tacit agreement that America's had with the rest of the world, in terms of America will buy everyone's stuff, and in return, they will sell them. I kind of laugh and say overpriced financial assets. And let's just take, for example, when you buy an iPhone. So we all buy iPhones. We all know, that this is being one of the greatest products and stuff like that. But they're manufactured in China. So when you go and buy an iPhone, we pay in U.S. dollars. But the trouble is, Foxconn, the company that makes these, they're actually going and they have to pay all their stuff in renminbi. So if in a truly free market, when they go and we would buy an iPhone and we would buy these, we would pay for it in renminbi, we would have a situation where the renminbi or the Chinese yuan would increase in value. And as it increased in value, it would get more expensive, and then it would become less likely for us to continue to want to make those iPhones in China, right? But the thing is that China recognized that, and they said, well, we have to keep the price of our renminbi down, because if we let it rise as Americans buy all of our stuff, we're going to have a situation where we'll no longer be competitive. So what they did was the People's Bank of China says, okay, this is what we'll do. We'll take the American dollars that the consumer is paying for their iPhone. We'll exchange them, and we'll give Foxconn renminbi on the other side. And it's easy for them to go and do that because they're the sole issuer of the renminbi. They're the currency, the monopoly on their currency. So the reality is they can create as much of it as they want. So they do this. Now, the trouble about this is that now all of a sudden they have all these US dollars. So they leave them in the US, financial system. So they start to buy bonds, and then eventually you'll go in a situation where it'll be even things like central banks go out and like the Swiss National Bank will actually buy stocks. But at the end of the day, one of the things that we need to realize is that the America doesn't export anything, or doesn't not. That's not fair. On the net, they don't export anything because they have a trade deficit. So
Right.
by its very definition, on the other side of that is them, the rest of the world, putting money into the US. And this has been a terrific relationship. And not only that, if you think about it, part of the reason that the American stock market and the American financial market is so robust, and not only that, why their stocks are priced like this, is because they've been willing to run the largest trade deficits in the world.
Mm-hmm.
Right. And so it's one of these things that it actually creates. As they get stronger, they get wealthier, and therefore they'll buy more things from the rest of the world. It gets larger and larger and larger. So But one of the interesting parts about this is that Trump is now telling us that he wants to get the trade deficit down to zero. He views the trade deficit as a negative. Like he says it all the time about us in terms of Canada. He says,
Right.
we're subsidizing you because you're buying, in essence, you're buying $200 billion extra of oil from us. So he views that as a subsidy. So he is trying to get the trade deficits down. Now, the other day, someone sent me this chart, and it was a chart of the change in the trade deficit versus the change in the price of the NASDAQ over a year time. And when I first saw it, I was like, it was so tightly, like the correlation was so tight. I was like, that can't be right. I was like, oh gosh, that's got to be wrong. He's done something wrong. So I was like the old Ronald Reagan, trust but verify. It's like I recreated it myself. And I was like, holy smokes. And I had no clue about the sensitivity of the NASDAQ to the trade deficit. But when you think about it, it makes sense, right? Like that money that is when America goes and buys extra stuff and then that money comes back to them, it stays in the financial system. And that stays in the financial system, puts the price of financial assets higher. And so if Trump is successful in getting the trade deficit down, then that will once again mean lower financial asset prices. Now, when I talk to really smart guys, like when I go talk to like the guys in the pod shops that are the macro traders, they'll tell me, "Oh no, you know what? I completely agree with you. If he was able to get the trade deficit down, he would actually cause the stock market to go down, but he doesn't want that. He wants the stock market to stay up. He'll figure that out and he'll stop doing it." And I'm like, "Okay, maybe, but he seems pretty consistent in terms of his willingness and his desire to get middle America put back to work. And by the way, that is what is on the other side, the kind of the negative about a trade deficit is
Mm-hmm.
that no longer can America afford to make anything because it's gone too expensive. And so that is what Trump is trying to change. And if he is successful, and I'll fully accept that he might not be successful, and I'll say, okay, that's fine. But if he is successful, that once again means lower financial asset prices, lower stock market.
Okay. Let me ask you this, and
Yep.
neither of us are political analysts, right?
Right.
So you're just really guessing here. Um, First administration, Trump used the S&P as a scorecard, right?
Yes.
S&P went up today. That means I'm doing great, right?
Yep.
Um, so far, you know, past 30 days, we don't have a huge sample set. He really hasn't been talking like that. And so
Yeah.
my question is do you think it's more important to him as he realizes this is likely his, I mean, it should be his last term, um, that that he's playing for legacy? Like when I'm gone, people probably aren't going to talk about, oh, it was 4 years of a rising S&P, and it's more the guy restored the middle class, or the guy got the debt under control, or the guy, built monuments all over the country with the big Trump name on it, or whatever it is, right? So do you think he's playing for legacy more this time versus what the S&P
What?
does?
So one thing is in the first administration, I believe that he was insecure in terms of assuming that his advisors knew more than him. Like
Mhm.
he would listen to them more. I think he's got more of his own plan this time. He's like, nah, you know what? These guys were idiots. They didn't really help me. I know better. I'm going to do what I want. And if you go look at his politics in terms of his economic politics throughout history, he's been consistent in terms of, believing that foreign nations are taking over extra jobs and trade deficits are bad. Like
Or
I
bad?
think he took out a full page ad in the 80s against Japan in the New York Times. Like this was way back when Japan was the big, the China of this day.
Yep.
So I am taking Trump at his word. I'm not going to second guess him. I think that everybody else is saying, no, no, he doesn't mean it. He doesn't mean it. And yet he's kind of, everything looks to me like he means it. And I think he'd be better off just accepting what he says. And yes, he's prone to hyperbole and does some stuff, but on the whole, it's pretty clear to me that he's planning on using tariffs as a revenue source. And I think the bigger question, Adam, the next part of it is, I don't think tariffs are going to ultimately work. And this is the real problem. For him to actually go and put middle America back to work, the US dollar needs to be significantly lower.
Mhm.
And that is the real problem. Like, go back to the Chinese keeping the renminbi much too low so that they, the iPhone production stayed, competitive. That is the problem. So when I think about trades going forward, one of the things that I absolutely love is owning foreign exchange volatility, meaning owning options on on foreign currencies. And I think it's only a matter of time before we're getting Trump tweeting or Truth Socialing or whatever it is about the yen being too weak, the
Mhm.
renminbi being too weak, and this is going to be just wild. And we're going to start to see some big, huge sparks, some huge moves in volatility, and ultimately for him to put Middle America back to work. Tariffs might help, but like, let's just think about. I stumbled upon this great documentary about John Deere. And if you remember, John Deere was going to take their factory to Mexico or somewhere. And then
Yep.
Trump said, I'm going to put 100% tariff on it. And then they followed these reporters went and actually followed through and went to the John Deere dealership, went to the Case dealership and followed through. And then they went through the math. And it was like, it didn't matter with the 100% tariff. It still made no sense for them to build tractors in Idaho or wherever it was. And so I think that the real problem is that the US dollar needs to be much, much, much weaker. And ultimately, again, that's going to be, once he starts doing that, that will encourage more money to leave the US. So it'll be kind of a self-fulfilling prophecy. It'll achieve two things immediately for him, in terms of it'll make his exports more competitive, and then it'll also stop as it goes down, it'll stop people wanting to leave money in the US in terms of being attracted to it. Anyways, the long and short of it is, Adam, I suspect that ultimately the trade deficit will only be fixed with the US dollar, and that will be the final piece of the kind of puzzle.
Okay, but fixed by the US dollar declining by a lot.
Correct.
Okay. So one quick question, and then
Yeah.
I'll reiterate to make sure I understood what you said in terms of
Yeah.
where you see opportunities. Um, I think I hear you saying to people, and this goes back to my question about, is Trump really playing for, big legacy here, that the people who are saying, um, hey, don't worry if we hit hiccups here, Trump's going to back off because he's never going to let the US stock market go down. I hear you say, I wouldn't take that as a given.
Correct.
Okay. All right.
Correct. 100%. And you
100%.
know what? I think Mike Wilson from Morgan Stanley just brought that up on Bloomberg today. He says, listen, I don't hear him talking about the stock market at all. And you highlighted that as well. He's not talking about it. When was the last time he spoke about the stock market? He hasn't been. He's been
To,
talking
to,
about
to,
tariffs.
to be honest, the only time I remember of late, which was before actually he got into office, so it was probably a month or two ago, uh, he was really interesting. He took care to say, I don't know what the market's going to do. So it
Yeah.
wasn't the like, oh, it's going to be a big, beautiful market
Yeah.
under me. It was like, I don't know, it could do anything.
I almost wonder as well. Elon has been talking about the pain that everyone must feel. I almost wonder if they understand that these policies that they are putting in place are going to be painful, and they're almost expecting it.
Well, so on that, I've said multiple times. In fact, I think I said it twice in my previous interviews today, that if I were advising Trump, I would be saying, look, you should be getting out ahead of this, because a question I've asked a lot for the past couple months is, let's assume Trump is successful with his policies in the long run. Can he be successful in the long run without near-term disruption and pain, in the economy and in the markets, as we take the necessary medicine to make all the changes to do what he wants to do? And most people I've talked to have said, No, he can't be successful without that short-term pain, right? So I think Trump should be saying, hey, look, folks, boy, now that I'm here and I'm looking under the hood, this is so much worse than even I thought. It's good you have me here. I've got this big, beautiful plan, but
Yeah.
it's going to take a while to get there. So we all got to tighten our belts in the short term. One, to set expectations, and two, um, if he doesn't do this and we do have some pain, then there might be a big blue wave in the midterm elections, which might thwart anything that Trump wants to do after that, which also might be a reason why he's scrambling at light speed right now. Like, let me get all the change in my first two
Right.
years
Yeah.
in case there is a blue wave, right?
Right.
But I personally am on record saying I think it's a mistake if he doesn't get out and give that sort of, hey, there's going to be some licks we're going to have to take. And he can blame it all on the predecessor, like
Right. I think
do it
that's going to
now.
come. You're absolutely right.
Yeah,
And
but
by
he
that,
better come
by the
soon.
yeah, and if you think about that, if you're correct, and or if we're correct in terms of our how we play it out, you'd be better off doing it sooner because it's easier to blame it on the predecessor when it's not 2 years later.
Exactly,
Right.
exactly. So, and even if the pain takes longer to materialize, at least he said, "Hey, this is what I was telling you about at the
Yes,
beginning,"
that's
right?
true. Yeah.
So maybe Elon's starting to carry that water, and we'll see what happens. But again, that would, I totally hear what you're saying there. Okay, so in terms of how you're playing this, or looking at playing this, um, you think Forex volatility, really interesting. Totally get that. Sounds like you're playing that with options. I'm not going to ask you for tons of details here because we don't have a lot of time. I just want to say, folks, if you're thinking about potentially considering any of the stuff, if you've not traded Forex before or options in Forex, don't just start trying to figure it out on your own. Talk to a financial advisor who's experienced in this, or follow somebody like Kevin. Definitely follow him. All right, you think the US dollar is going to go down by a lot? I'm going to guess over the next coming years. You probably don't have a timeline for that per se, whether it's going to happen, the
Yeah.
drop's going to happen a lot now or a lot later, but you think between now and a couple of years from now, it should be a lot lower for the reasons
Yep.
you mentioned. Developed market equities and emerging market equities, I'm assuming you think are going to catch a bid here as the capital flows out of the US.
Correct.
You think US equities are going to not do well for the reasons you've talked.
Correct.
Okay. Let's see. Anything else you want to talk about there? But two questions for you specifically. What'll be the impact for bonds? And obviously, I would think gold would do well in this environment, given what you mentioned, and probably commodities in general.
Yeah. Um, so let's start with bonds. Bonds are a tricky one. And uh, in a regular environment without the tariffs, I would probably be getting bullish bonds. I would probably be getting, okay, they're pulling back on spending. We're gonna see the economy roll over. It's easy to get bullish bonds. One of the worries that I have is that this is an unusual environment in that the tariffs by themselves are inflationary. So yes, they will cause the economy to slow down, but they will also be inflationary. So it's kind of the worst of both worlds. Not only that, I don't know if I think people are overestimating the potential upside in bonds. And let me just kind of lay out how I'm thinking about this. If you think about the typical 2 year, 10-year yield spread, meaning the difference between those two,
Mhm.
when we have a situation where the Fed goes and lowers rates, what happens often is, or almost always, is that the yield curve steepens. As it goes down, we get a situation where the economy speeds up, and therefore you get a situation where people sell the long end and the short end goes down. So in terms of yield, and so the yield curve steepens. So in the past we've had this yield curve that was inverted. It was inverted for the longest time, what I think ever. Like I think that was the longest inversion that we've ever had. But now we have finally got a situation where it's starting to normalize. The Fed, let's imagine that the economy rolls over here and the Fed starts to aggressively lower rates. So the question is, what are they going to lower rates to? And so let's just and we talk about that as being the trough rate. Like how far are they going to get it down? And a lot of people have this vision of this return to the post GFC, pre COVID era of 0%
Oh,
interest
sure.
rates.
Yeah.
Yeah. And I'm just like, I don't believe that's going to happen. I don't think that that's what we're going to see. And so I'm sitting there and going, okay, let's imagine they cut it to 2.5. I think that would be a fair level to cut it to. Now, the trouble about it, they cut it to 2.5. what happens is generally 210s go from, 0 or minus 50 to like 200 positive. So we could have a situation where the 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 Fed funds are 2.5, and we actually have the 10-year unchanged at 4.5, meaning that the yield curve is normal shaped, and we have a situation. And let's not just forget that we talked briefly about the term premium and the fact that it hasn't actually been that wide. If we got a situation where people started to get more concerned about being wider, we could have a situation where term premium increases, meaning that the long end's yield increases even more.
Yep.
So although I could see a situation where the Fed's lowering rates to 2.5, I don't think that the long end is going to do anything. So it's going to be a really difficult trade to do. And even when it comes to the short end, because there's some people that would love to go play things like the TUA, which is like a levered 2-year. The problem is that very quickly, the moment the economy starts to get weak, we're going to get a situation where they're going to immediately price in 10 cuts or 12 cuts. Like, it wasn't that long ago. It was like in the summer they had priced in 11 cuts, and
Yep.
here we are, and they've had what, 3 or 4, like, or 5 maybe total. But the market had gone completely wrong. So the trouble about bonds is, I think it's a mugs game. I don't think there's any attractive opportunities there. And in fact, although I love buying volatility across the board in terms of, and this is very unusual for me, Adam. Usually I hate buying volatility, but in this case, I think because of Trump and because of the crazy policies that we're seeing in terms of these changes, that owning long-term options, not short-term, long-term, like I'm talking about 1 year options, I think that's a much better way to express deltas, meaning like if you're bullish on the yen, you buy 1 year calls. If you're bearish on the NASDAQ, you might buy 1 year puts. Long dated options, I think, would make a lot of sense. The only part or asset class that I'm kind of hesitant to buy longer dated volatility is our options, our fixed income. And the reason for that is we've already had the large move. And coincidentally, the move index, which is the fixed income equivalent of the VIX, their volatility, their implied volatility rate, you could see it went from 40 basis points to 160. And this was an abnormally large move in the move index. And it's still high. And I actually, if anything, consider that probably more of a sell. And if you were in a situation where you were long all sorts of volatility in different things and you were looking for something attractive, I love Harley Bassman's MTBA, which is a mortgage-backed ETF. And the reason that I love that is kind of there's an implicit short volatility component to that trade. And not only that, when you look at the current mortgage-backed coupon versus credit, it's actually extremely, extremely cheap, whereas credit's really expensive. So to me, it makes sense to own mortgage backs as a way just to kind of hide somewhere to hide in fixed income. But that's a lot of inside baseball. That's very sophisticated in terms of players. But I think that in terms of bonds, it's very difficult to make any real money. And the only pushback I will have to the people who are really bullish is make sure that you're not talking to people who think we're returning to that post GFC world of
Yep.
ZERP.
If to
And
be
yeah,
successful, we have to go back to ZERP. Yeah, that's
right. And
a
I
big
just think that
assumption.
I'm don't count me in one of those. Okay, so then the next question was gold. Gold, I have loved gold for a long time. And I've loved gold even as the US dollars rallied, even as the rates have been rallying. And I've continually advised people to say, throw away all those previous relationships that we used to drive gold,
Mhm.
because the reality is that once Russia was zeroed by the West in terms of their foreign exchange holdings, that the Bank of China, the People's Bank of China, would have no choice but to diversify their assets into gold. It's just like, just put yourself in their shoes. You sit
Right.
there, you see the Russian, you see the fact that they owned all these treasuries, then all of a sudden they're zeroed. You're sitting there going, well, that could happen to me. I have to buy something else. What can I own? Gold is the natural situation, the natural kind of offset to that. Now, the trouble is that the gold market is so small that they have been trying to not cause it to explode higher. So they've been just accumulating gold over and over and over and over again. And every time everyone got bullish, I said, don't get too, sorry, everyone got bearish, I like, don't get too bearish. The People's Bank of China will be there. And that's what's continuing to happen. And as a quick aside, Adam, I was out with when I was in New York, I had the lucky, fortunate ability to sit with a gold trader. And I said to him, I said, like, do you know when it's like the People's Bank of China buying? Like, I was like, do you know? And he
Mhm.
says, well, we don't know for sure, but we see Chinese banks coming in, and we know that it's probably them when they put it on a plane and take it home. And that's happening all the time. And so they know, like they know when they're buying. So I thought that was an interesting quick aside. So now in terms of gold, what's happened now though is that we've gotten the situation where the US dollar is finally rolled over a little. It looks like rates are going down. So not only do we have the People's Bank of China buying, but for the first time, we now have Western investors also starting to be attracted to gold. One of my concerns, and I think it's actually a fairly large concern. And this is, again, another reason why, if you're going to be trading gold and owning it for the long run, you should really consider owning it in terms of owning call options. Because one of my worries is that Scott Bessent at the Treasury has all of this asset in terms of these gold on his books that are marked at $42. And he's talked about this numerous times about potentially remarking that. And to me, one of the reasons you might remark it is you want your balance sheet to look better. You want it to, your income statement to change. But it also could be that, you've promised the Bitcoin guys that you're going to buy a Bitcoin reserve. The reality is you don't want to go to the Congress and ask for more money, considering that you're already trying to balance your budget. It would be a natural and easy trade to go, we're going to take X billion dollars of gold. We're going to revalue it from $40 to whatever the price is, 2,900 or 3,000 or whatever it is. And then we're also going to sell a little bit to buy Bitcoin, right? And if that happens, gold's probably down 300-400 bucks that day. And you should buy it with both fists. Because the moment the US starts selling their gold will be a terrific buying opportunity. Like every time governments have sold gold, it's been just a terrible, terrible trade. And like Canada, we did it. Britain did it. Britain, I think, sold the low and just did an ugly thing. And it'll be just so short-sighted of them to doing it. And I think the People's Bank of China will just be like, bought from you, like we'll take it, like,
Right. Yeah.
right, like
Yeah.
we've been waiting for
A
signs, like
trillion in
here we go.
gold, give it to
Yeah,
us. Yeah,
yeah.
exactly.
So I
By the
think
way,
that,
here's your treasuries back.
yeah, exactly. And I think that'll happen. But that doesn't mean that that day it doesn't go down a lot, but ultimately it'll be a very positive thing. But that's why owning call options as opposed to gold outright makes a lot of sense, because I
Okay.
suspect that we could see those moves. So that's the only
Okay.
bearish reason I have. Otherwise, I still think gold's going much higher.
All right, great. That's what I was going to ask.
Okay.
So that risk aside, sounds like you're still pretty bullish. Sounds like the
Yeah.
answer is yes.
Yes.
Okay, great. Well, look, I'm looking at the time. We've gone about 10 minutes over what I promised you. Thank you for giving so much of your
Oh,
time
my
here.
pleasure.
So I guess I'll wrap it up here. I've got one last question, which is where folks can follow you. But real quick, before we ask that, is there any other key asset that we haven't talked about yet that you feel you want to share with people, or did we do a good job?
Well, I would just say the other thing is, I've been bearish Canada for a long time. I continue to believe that Canada is going to be suffering, and it's not just the tariffs. I think that we're finally having our real estate correction. And so one of the things that I would tell people is, if you're buying Canada because you're expecting, or buying the loonie, our currency, because you're expecting oil to go up, or you're expecting commodities, go find another way to play it, because there's better ways to play it. And I think one of the big mistakes people will make is continually buying Canada because it's a commodity currency, when we're going to be suffering from this problem of our real estate finally rolling over, our economy finally rolling over. We have way too much debt. And one of the things that I will say, though, if in terms of our resource stocks, Canada, in terms of this, will encourage us to to all of a sudden open the floodgates for mining. It'll open the floodgates in terms of our energy,
Oil
making it
production.
so we we can sell it instead of at a $15 discount to you guys. We're going to start to make pipelines to the coast, and we're going to actually get better prices. So ultimately, I expect there to be a huge, huge resource boom in Canada. And so the US Canadian resource companies, we're going to have a cheap currency. Like the loonie is going to be really cheap. So we're going to be earning US dollars, which relative to the Canadian loonie will be really expensive. And at the same time, our costs will be lower and we're going to make tons and tons of money. So you can be bullish Canadian resource companies, but bearish the loonie.
Okay. And that resource boom, is that something you see really manifesting in 2025, or is that more a year or two out?
I think it's going to start right away. This is listen. We've gotten a huge kick in the pants in terms of I see uh, political parties that used to be green or used to be very much to the left lining up to start building the pipelines. It's a
Okay.
there's been a dramatic change in attitude in terms of Canadians' willingness to go and do resource kind of exploration and production. And so I suspect that we're gonna be flying. This is gonna be like 2000 and remember in 2000 to 2010 we had this huge commodity boom because of the fact that China was expanding so much. I
Yep.
suspect that Canada will have kind of a similar type thing in terms of our just existential threat is going to force us to do all sorts of exploration and all sorts of production.
Okay. Well, one of the next times we have you on, Kevin, I'd love to talk to you again. We're not political analysts, but we have to track the political changes that then impact the economy. So I'd love to hear more about, where you think policy is going to go in your country. I know the conservative leader, Pierre Poilievre, has very much had kind of a, time for us to really tap all of Canada's resources.
Right.
Sounds like you're saying even the other parties, even Trudeau's, which now looks like it might be Carney's, is also starting to lean more that way too. So
Oh, it's more than just leaned at them. They've completely embraced it. Like it is truly shocking how much it's changed, and I suspect that it's just lit a fire. And unfortunately, if you are a Pierre fan, I don't think he's going to win anymore because sorry, it's going to be a lot closer because the reality is these other guys have embraced the policies that
are
people
embracing
that
his
were,
playbook.
yeah.
Okay. I'd also like to talk about the real estate market correction that you now believe is starting to unfold there because you guys have had some of the largest housing bubbles in the entire planet.
Yep.
So that's going to have some real impact. And also, I'd love just to sort of spitball with you. Totally get why you think there's going to be a resource boom and the infrastructure that's going to get built. And Canada should build that infrastructure again. For all sorts of reasons, but one to make itself less dependent on any one particular country. But I would love to sort of spitball with you the odds that, Trump's negotiating style is to start with something that just blows your mind, right? And then in the negotiations, get to probably someplace more in the middle, but to you, it feels a lot better than the crazy thing he started with, right? And so
Yeah.
my guess is what Trump is looking for here with the threats of the 51st state and the tariffs and stuff like that is just to find see if there are a way to create better trade deals between US and Canada in ways that work better for both sides than what we currently have right now. And I'm just curious if you hold any optimism for that or not.
Oh no. Well, first of all, let's not forget he was the one who actually negotiated this last deal. That was his deal. Like, so we had a situation where there, and then not only that, he's reneged on a deal that he himself negotiated. So we are all of a sudden looking at this, going, "Holy smokes, we cannot rely on the deals being followed through in the future." And it's just kind of self-preservation is that we need to be less dependent on one place. And yes, we're going to figure out deals that'll work, but the trouble is that we can't assume that those will continue in the future.
Okay,
So
interesting.
it's like it's sad, and it's and in some ways it's better for us because I think that in the past we've gone and we've allowed our oil to be sold at a huge discount. And I know Trump sees it differently. And, you know, I am speaking as a Canadian, but the reality is that I've been frustrated about the fact that we've been selling our oil at $20 discount to you guys forever, because the reality is that our oil is landlocked. We don't put it in ships and send it off to everywhere else to get a world price. So you guys have been having this terrific deal. And even things like the cars, like, he talks about the cars and he says that they buy so many cars from us. Well, I went and looked the other day on the Goldman Sachs again, had this terrific net auto import, the net auto imports, like in terms of who was the biggest deficit. And we weren't there, because the reality is that we're about even. We buy as many cars from you as we sell to you. So we're even. So we have this deal where, yes, you guys do buy a lot of cars from us, but we also buy a lot of cars from you guys. And one of the other things is, if you actually pull our resources that we sell you, so take out the oil that we sell you guys, and then look at what's left, we actually run a trade deficit in terms of we are buying more value added goods from you guys than the other way around. So like, we have been sitting here not having the jobs in Canada because we've been letting you guys build all these things. So anyways, it doesn't matter. I know that this will be a little very political and people will be like, oh, you're not doing your job on the border. But even the border, again, Trudeau went down there the moment he announced that, asked him what he wanted, and said, fine, we'll spend that $1.3 billion. The deal that was announced at the last moment was actually agreed and announced in Canada uh, like the next week. So I'm not sure that Trump really is doing what you guys think he's doing in terms of wanting to extract deals from us. I think the reality is he wants to put tariffs on us, and we, have to deal with that. And the reality is, you guys have your choice about what to do with your country in terms of how you go about arranging it, and we have to just kind of look at that and go, okay, that's how they've chosen to do it, so we're going to choose another way. And again, I think ultimately it'll be better for us, but it's going to be many years of pain as we rejigger our whole economy.
Right, right. Okay. So, all right. So you're sort of proving my point, which is, to the extent you have the interest, I'd love to dig more deeply into this next time we talk,
Oh,
because
I'd
I
love
think
to come and chat with you about it.
yeah, there is a
Yeah,
lot that we Americans maybe don't fully have the full picture. I don't even have the full picture. And so hearing it from somebody like you who's in country is really useful.
yeah, I'm happy to chat about it.
All right. Well, look, we are at that key last question. For
Okay.
folks that have really enjoyed listening to you today and would like to follow you and your work in between now and the next time you're on this channel,
Okay.
Kevin, where should they go?
They can email me, Kevin at the Macro Tourist, and I'm happy to send them some recent examples. Or you can just go check me out at themacrotourist.com.
Okay, awesome. And Kevin, when I edit this, I will put up your email, which you're very courageous for sharing, and your URL on the screen so folks know exactly where to go. Folks will also be, those will be in the description below this video too, so you can get there with one click. All right, Kevin, well, look, it's always so fun to talk to you, and so educational and insightful. Thanks so much, my friend. I want to give you the last word. This future that you mentioned, right? Kind of rocky, especially if you're an American, for the next year or so, as a lot of the shoes that you think may drop start to drop, both in the economy and in the markets. Do you have any parting bits of advice for the regular retail investor as they sort of enter a year like this?
Oh, that's a great question. Well, one of the things I might say is that make sure that you keep your mind open to all sorts of different possibilities. And all you have to do is think back to 2022 and how I mentioned how everyone was bearish, and the reality was something completely different happened. And although I've laid out my, belief, it very well could be dramatically different. And one of the things that you need to do is just adapt as the environment changes, and make sure you keep your mind open to it. And I'll just leave you with my final thing that I'd love to say is that trade the market that's in front of you, not the market you wish you had.
Yeah.
Meaning that don't bother spending too much time thinking about what should be done. Just worry about what will be done.
Kevin, I think you should get some covers for your headphones to make them like pointy Vulcan ears, because I hear you and I think, you say invest like a Vulcan, right?
Okay.
Don't let your emotions get in the way. Don't think about what the market should do. Just think about what it's doing and just be
Yep.
completely dispassionate.
That's great.
All right. Well, look, my friend, it's been absolutely fantastic. Thank you so much.
Thanks a lot, Adam.
All right. Well, now's the time of the channel where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. You'll see that by my change of shirt and my haircut, that it's a couple days after we recorded with Kevin. So lots to talk about. John and Mike, again, as folks as usual, I'm joined by John Loder and Mike Preston, the lead partners there at New Harbor Financial. So guys, I'm sure you've got things to respond to in Kevin's part of the interview there. In the interim, we've had some developments happen, both economically. The tariffs have just gone into place again against Canada and Mexico and China. The markets have definitely had some heartburn over that. Recession is suddenly in the headlines these days, and we had the address to Congress, and so lots to react to in addition to just Kevin's part of the interview. But Mike, why don't we start with you? What were some of the key takeaways that you took from Kevin's expectations here going forward, that things are going to get rocky, especially in the U.S., and that we're probably over the next couple of years going to see a reversal of all the foreign inflows that came into the U.S., and we'll actually maybe see capital start flowing from the U.S. to foreign markets?
Hello, Adam. I'll do my best to do a quick recap of what I thought was the most important pieces of Kevin Muir's talk here today. It's a breath of fresh air for us. We are tacticians slash technicians. A lot of our job is looking at charts and the relative performance of different asset classes in the universe and doing a lot of charting and things like that, and then making investment decisions, not wholly on those factors, but that takes a lot of the time of what kind of work that we do. Kevin here talks really about the macro stuff, the economic stuff, and we certainly focus on that too, but I would say less so than the technical side. So it was kind of it was insightful and a breath of fresh air. So big theme that Kevin talked about here was the fiscal deficit that the United States has run over the last bunch of years. And, I might say it's really been over decades now, to be honest. And a fiscal deficit on the government's part equals, as he pointed out, private sector credit. So if you're running a government deficit, it's not necessarily a bad thing for individuals, because government deficit equals credit for the private sector. So Kevin talked about how after COVID, we were at a 25% deficit for COVID. Absolutely insane. Some would argue that was needed. It might have been a little overkill. It caused a lot of inflation. It caused inflation to shoot up to 9%. That's the whole reason why some of these I bonds were paying 9%, at least for a while back then. Now we've got a 7% deficit. We're still amongst the highest in the world, Kevin points out. Canada's running 2%. I think he said China was like 2 or 3%, but we're still running at a deficit. And now all of a sudden Trump comes in, and Trump says, you know what? We want to reduce the deficit. And Trump hasn't been talking a lot about the stock market, as Kevin points out. And so that has some people a little bit worried. Maybe Trump doesn't care so much about the stock market. I'm having trouble believing that right off the bat, but there's some potential early indications. And there's a theory that says that maybe Trump and Bissett care less about the stock market than getting the deficit under control. If that's true, and the deficit is going to be rolled back and reduced from its current 7% deficit spending budget annually, maybe it's going to be reduced down to something in the low single digits, or God forbid, the other way, negative. That is going to mean bad things for the private credit sector, and it's certainly going to mean bad things for the stock market. So that's a warning that Kevin talked about. And frankly, we're at amongst the highest valuations that any of us have ever seen in our lifetime. It's only been rivaled a couple times in history. And so there's a lot of reasons to be concerned. We don't know if the stock market will crash. We don't know if it's just going to go sideways for a long period of time. Kevin doesn't really try to predict that either, but he says that, look, there's a lot of bullishness out there. He points out that 60% of institutions think the U.S. market will go up, and usually you want to take the other side of that bet. There's other shorter term indicators that are saying that the stock market's getting short term over bearish, but I think that Kevin focuses on the intermediate to longer term. At least that's our take. And so from the intermediate to longer term, he's saying that 60% of institutions think the US market's the best place to be. Well, shoot, if we're going to be reducing the deficit spending, maybe it isn't the best place to be. And he points out that some other areas, some other sectors of the market, like European stocks, are starting to pick up. And he's theorizing that maybe in Europe, they're saying, hey, we're going to get these tariffs. Maybe we need to do some deficit spending here. Maybe we need to focus on our infrastructure. And so deficit spending in Europe and maybe even in China, we'll see what happens, because he says there's a big meeting coming up sometime in March over there. If we start to see deficit spending in those parts of the world, then maybe that's what the market is starting to sniff out here. So that's what I took from what he talked about there. There's so much more here, except I think I'll just end with a couple points. Number one, he thinks there's going to be years of underperformance for this U.S. stock market. We 100% completely agree, because valuations are very, very high. Everyone thinks that the U.S. will always be there. Now, the country, yes, will always be there, but everyone thinks that the U.S. will always be there at the top of the pile in terms of performance. And that's very much not likely to be the case. Lastly, in terms of things that he thinks make sense, foreign currencies, we're seeing a major breakdown or at least a moderate breakdown in the US dollar right now. Happy to share some charts a little bit later. So bearish US dollar, bullish foreign currencies, things like emerging market stocks should do well. Somewhat iffy on longer term bonds. We can dive into that later. We actually do like longer term bonds and ETFs like TLT. Whenever we mention the ticker, it's not a recommendation. It's just something that we use to demonstrate an idea. Volatility, he talked about volatility, being bullish on volatility, and certainly bullish on gold, which we are as well. I'm happy to dive more into some of these themes, especially some changes we're seeing in the markets a little later on, but that's my attempt to recap. Thanks, Adam.
Okay, well, those bullets, bearish US stocks, pro international stocks, pro volatility, pro gold. That's actually been a really good playbook so far for the first 2 years of this year, at least. So at least his playbook is doing him pretty well here in the near term. I also know in his very recent writings, Kevin is increasingly bearish about where things are going. He talks a lot about how some other very smart investors that he has known or followed in his whole life, like Steve Cohen, think similarly and said, bet against those guys at your risk. So, it is interesting because Kevin is not a perma-bear kind of guy, and matter of fact, was actually pretty bullish in 2023, 2024. So for him to reverse here is it's always notable to me where somebody who's been sticking their neck out one way suddenly shifts and sticks their neck out the other way. John, all right, let's come to you. What else would you add to Mike's key takeaways here?
Yeah, well, I'd like to pick up and really maybe bring in some charts to speak to the dramatic overvaluation of the U.S. stock market relative to foreign markets, really what Kevin talked about. And despite those dramatic differences in valuations, U.S. stocks have been, as we know, the only show in town for longer than we can probably care to admit. I did a video on our channel that talked about, what kind of telltale signs we typically will see at major market tops. And in there I list, and this just came out about a week ago, I list, 4 or 5 factors, one of which is valuations, but extreme valuations on the high side aren't enough to cause a top in a particular market or geography. Same can be said at extreme valuations on the low side. Just because something's undervalued doesn't mean it suddenly is going to outperform. In fact, we've seen persistent undervaluation of foreign stocks, and they're just now starting to kind of catch some bids here. So I want to put a longer term perspective on that whole discussion. I think we're very early in what will likely be a multi-year, multi-decade kind of rotation. And let's do this. I'm going to share a PowerPoint slide here just to highlight that. So this is a chart, goes back to the beginning of 2023. So after the 2022 mini bear market here in the US, it just compares the S&P 500 ETF SPY with a broad developed market foreign equity ETF EFA. And you can see orange line is the SPY. That's dramatically outperformed over this two and a quarter or so year period. But you can see of late, starting with this year, the foreign stocks have dramatically outperformed while the S&P has actually turned down actually on the year to date. So very quick turnaround here so far this year to date. But let's zoom out, look at longer picture. This is going back to essentially the turn of the century or just after that. And you can see anytime this bottom pane is trending down, it means foreign stocks, as measured by EFA, are kind of outperforming or outtrending US stocks. But you can see, and much of the wake of the tech bubble, for example, saw foreign stocks, and that's this purple line here, blue line, soundly outperforming US stocks. But and that stuck until about on a cumulative basis till about late 2014, I think that was. And then we had this massive one-way, largely fueled by the things that Kevin talked about, the fiscal spending, the monetary juicing of markets, and you've had this dramatic outperformance of U.S. stocks until this little blip here. You can see this suddenly the U.S. stocks have started to underperform the foreign stocks. A lot of strategists are talking about this. You look at major asset class forecasts over the say the next decade, whether you're talking about Goldman Sachs or GMO or Vanguard or BlackRock, they all have pretty profoundly more optimistic forecasts for, say, over the next decade returns for non-dollar denominated equities, foreign equities. And one site that I want to share here, it's a great site. It's put out by Research Affiliates. I know you've had a strategist from Research Affiliate on your program
Chris
before.
Brightman, yeah.
Yeah. So they have a cool, people at home can use this just to kind of see at least their views. Now I'm going to share this not necessarily to blanket endorse or validate or say we agree with everything here, but the takeaways I'm going to point out here, we certainly agree with. So here is what they call their asset allocation interactive. And there's all kinds of different ways you can slice their research. But this one here I have here is a look at their expected 10-year inflation adjusted, real returns over the next 10 years. So it's a scatter plot showing volatility along this axis, meaning, the further right you go here is more volatile. And on the vertical axis is expected returns over the next 10 years, real returns. So the sweet spot is, getting the most return for your volatility buck. If you look here, this is large US growth stocks. They actually show a negative 0.5% annual return in real terms over the next decade. Okay, and that's not unlike the forecast of GMO, folks like John Hussman. Goldman Sachs, I think, even has a negative real return, slightly positive on a nominal basis. Compare that with...
Sorry to interject, but not only a negative real return over that period, but a volatile one. So it's like
volatility.
both worlds. Like you'll lose sleep at night and you'll lose money.
Exactly. You look at, however, you look at developed, international small cap, stocks, 7% annual return with essentially the same volatility. You got emerging markets, broad emerging market equities, slightly more volatile as they tend to be, but a much more compelling return outlook. Again, I'm not necessarily validating everything here, but from a macro standpoint, we do believe these trends will play out, and we don't have to anticipate them. We can start to see them in the tools that we use, like relative strength. And just recently, we saw a relative strength signal start to favor foreign stocks. So we're going to be looking for opportunities to rotate into more non-US dollar denominated equities and even bonds. While we're here, we'll look at their plot of returns in the bond market. This is a comparison of duration. Duration is a close relative to maturity. I won't get into that right now, but longer duration means longer dated bonds. And then this is their expected real return. They have a pretty low long-term U.S. bond forecast. We're a bit more optimistic about that, mostly because we think it will rally with a slowdown in growth and certainly ultimately a return to very stimulative monetary policies. But look at the outliers here. We actually just added within the last week a slice of intermediate term global emerging market debts denominated in local currencies. And they are projecting, and they're not alone. Folks like Van Eck are very bullish on this. so much lower duration risk, interest rate risk, but very soundly positive forecasted returns, in part because of the dollar. Dollar weakness, all else being equal, translates to a tailwind for foreign stocks. And I just finished by sharing a chart of the U.S. dollar, because we talked about this at length with you and Tavi Costa last week. So I'll just kind of go to this a bit here. This is a long-term chart of the DXY. It goes back to 2005 or so. DXY is the main dollar index. It's heavily weighted against things like the euro and yen. And you can see over this broad history, the dollar has generally strengthened, but it's been in a very tight trading range since about the middle of 2022. Zoom in closer, and we had this broad trading range. It poked out what looks to be a head fake, and we're having some very strong, very weak moves in the dollars here. In large part, I think, because of the economic policies that have been talked about and starting to be put in place. And we're having just today, the dollar is, here we are recording this on the 5th of March. We're having a little mini collapse in the dollar. That should do, very powerful things for non-dollar denominated assets, including things like commodities and precious metals and real assets. So those are some big picture takeaways I wanted to kind of call out from Kevin's comments there.
Real quick question for you on the dollar weakness there. Now, I think many people have been expecting that tariffs would cause the dollar to strengthen. And of course, we've had a lot of news recently about increasing tariffs, increasing aggressiveness from the Trump administration on tariffs. Why do you think the dollar is falling in the near term on that?
Well, there's a lot of different factors at play here. I know Treasury Secretary Bessent has been, not so shy about talking about a weaker dollar, especially in a trade-weighted basis. The DXY I just showed you there is not really reflective of a trade-weighted dollar. It's more reflective of comparing it very heavily to like the euro and the yen. But if you trade weight it, the dollar has actually been much more strong, and that is a headwind to our economic growth, and it's certainly not helpful for multinational U.S. companies that want to export to other countries. A strong dollar, it makes it more expensive for foreign countries to buy our goods. So I think it's really an intentional telegraphing and market reaction to some of the policies that have been. I haven't done the game theory on what a tariff in isolation does to the dollar, but I think broadly speaking, exporting, and right now we're in this kind of doom loop of tit for tat tariff, kind of posturing. I think remains to be seen how that plays out. But even just yesterday, Howard Lutnick, the Commerce Secretary, was within 24 hours of the March 4th tariffs going into play, kind of talking soft, almost like a conciliatory tone. So these tariff headlines, I think, are going to be noise that probably mostly deserve to be ignored, and instead looking at what the market is telling us versus the headlines.
Okay. Well, the market right now seems to not really be entirely sure what it thinks, because the volatility is higher. And on the day we're talking, as we've been talking, I've been watching the markets. It's gone back and forth, red and green, multiple times in just the 12 minutes we've been talking here. Okay, so a couple quick things. So you mentioned firms that are singing a similar song as Kevin in terms of expecting international markets to outperform in the coming years. You mentioned GMO, you mentioned Van Eck as two of them. Just want to remind folks that we're going to have one of the co-asset managers at GMO, John Thorndike, presenting at our upcoming spring conference in a little over a week from this recording. So if you're interested in really hear what GMO is thinking, we're going to go deep into that with John. So go register for the conference if you haven't already. And then Jan Van Eck, regular viewers of this program may recall that we've started this quarterly process, or quarterly event with Jan, where he comes on and he walks us through his outlook for the coming quarter. We just booked that. I just booked that with him for early April. So folks, that'll be coming on this channel in a couple of weeks. And those are always great. Jan always brings a ton of great charts and is very generous in how he sees the road ahead. All right. So one thing I want to note, and gentlemen, we'll have to wrap up relatively quickly, just because we've fortunately we're able to go along with Kevin. So I mentioned at the beginning here that a lot of things have happened over the past couple of days. Markets have weakened, volatility has gotten worse. We've had the tariffs really officially kick in. We've had recessions suddenly start popping into the headlines. Really, I think everybody had kind of hoped that dragon was dead, but all of a sudden it's now again back in people's zone of concern. And one of the things that I've talked, I'm sure with you guys about, but a number of people on this channel is, would it make strategic sense for the Trump administration to communicate that, hey, folks, we're releasing this flurry of policies that are intentionally disruptive. We think they're going to get us to a great place. But hey, we inherited an economy that had a lot of issues. And B, these disruptive policies are going to be disruptive. And so there's going to be some rocky road for us to get through before we get to the end where hopefully everything should be a lot better. And, kind of a call for unity about, hey, we're all going to need to tighten our belts together a little bit here. And we've talked about whether is it a communications mistake that the Trump administration isn't really being that declarative yet. I will say in the news recently, I have seen Scott Bessent start delivering that type of message. And then last night at Trump's address to Congress, he did say several times, bear with me. It's like, look, yeah, it might be a little rough in the next, here and now, but just bear with me. It's going to be great. So I think to me, it seems like we're actually beginning to get a nod from this administration of like, hey, folks, yeah, we may have a little bit of tough times ahead here. Are you guys seeing same? And I ask this because I'm starting to see from this audience here, people who have been saying, I've kind of been enjoying how the animal spirits ran wild and my portfolio has done pretty well since the election, but now I'm starting to get worried that the world is waking up to the fact that it's not all sunshine and roses. Maybe recession risk is increasing, and maybe I actually got to start getting serious about putting some protection in my portfolio, because it seems that the honeymoon period is ending here and people are getting legitimately concerned. Are you seeing this in the people that are reaching out to you as well? Are you hearing concerns from your existing clients? Mike, let's start with you.
It's a legitimate theory. You talked about that. I mentioned it as well in my recap that, the Trump administration being, ones that want to reduce the deficit are going to go out there and blame. They're going to say, we want the deficits to go down. And they know that that's going to hurt the private credit. They know it's going to hurt the stock market, and so they can blame on the predecessor. That's what I think both you and Kevin said. That's a valid theory, and I guess we can see that happening. It makes sense. We try to take our signals from what the market's actually doing more than anything. So while we'll be aware of that, we're going to take the majority of our input from market signals, and the market signals near term have all unsurprisingly flipped into very negative territory because of what we've seen over the last couple of weeks. And I just said a minute ago too that institutions expect the US to outperform. That's usually a bearish, kind of contrary indicator. Just to be balanced though, I guess I'd like to share one chart really quick here that actually kind of looks like the other direction. So shorter term indicators, and hopefully you can see this chart now, Adam.
Mm-hmm.
Shorter term sentiment indicators like the American Association of Individual Investors, AAII survey. This thing has surprisingly been very whippy. The S&P 500 is down 6%, and boom, here we are up at 60% bears, right? I just said 60% of institutions are bullish, but here 60% of AAII participants are bearish. And so this thing needs to be looked at too. Take a look at some of these other times that have got above 60%. These are pretty big lows in the market. This is pretty rare for at least shorter term indicators like this and sentiment to flip this bearish on such a small drop in the market. We've only seen around a 6% drop in the market. So because of the bearishness on our own indicators, we have tightened up defenses. We have sold additional call options on some stocks. We're certainly not adding exposure, and we're looking to see if recent lows have been taken out in the market. And if I could just spend maybe 2 seconds doing that, I can show you an S&P chart here, and I'll go to that now, just kind of end with that. So the first thing I'll show is actually a NASDAQ chart, then an S&P chart. This is the NASDAQ composite. Hopefully you can see that now. The NASDAQ, came down really hard, came down almost 10%, 8-9%, over 20,000, just down to about 18,000, went through the 200-day moving average, and it's fighting at the 200-day moving average. So this is a bearish sign. Until we can recover, that's bearish. S&P 500 also fell pretty hard through the 50-day moving average, which is here in red, down to almost the 200-day moving average in green. Ironically, the hedges that we so often talk about, we've got hedges on 15% of our positions. Did you want to say something there, Adam?
No, I was just chuckling that it came close to triggering them, but it hasn't yet.
Exactly. So, right, ironically, our hedges are right there at 5,700 and right at the 200-day moving average. And so we have an inside day on the S&P right now. We'll see. We could easily bounce, and that would surprise everybody. Now, we're not going to anticipate. If that happens, we'll have other plans. But one thing that has us on the lookout for that is the fact that we filled this gap back here at roughly 5,800. We blew right through it. And look, if we crash right from here, we're positioned for that. We're only at about 40% equity. We reduced recently a couple percent in the drop last week. And if we drop right from here, our hedges will kick in and we'll take some additional stops. But if we bounce hard from here, we could see a run for the highs easily if we went through the 50-day moving average. And I know that sounds like me trying to have my cake and eat it too, but I guess I'd just say that we have set our equity allocation low in light of the fact that we're walking on a tightrope at 30,000 feet. At these valuations, that's what it's like. It's not like walking on a tightrope at 10 feet. So it's a tough job being a money manager. It's a tough job for a lot of individuals out there. We get that because of where we are. But take a look and see what happens here. If we have a big follow through day, let's say to 5,900 or so in the next few days, I don't know. I wouldn't say it's an all clear. I'd just say be on the lookout then for a close above the 50. So it's either that or we're going to drop to the 200. And we will take our cues as they come, so to say.
Okay. Hey, Mike, how notable is it that pretty much, at least as of this most recent bounce, the market has given up all of its gains that it's made post the election? So basically the whole sort of Trump bounce, the whole sort of, whoever was going to get excited about the administration, all those animal spirits have basically left the building at this point.
Yeah, I mean, just taking a look here, it's pretty significant. I mean, but again, I hate to have it both ways, but it oftentimes is the negativity that fuels another run higher. I want to be really clear here. We're not trying to play games in this market because we think that ultimately this market tops and drops very hard. Right. But we unfortunately have the unenviable position of having to try time things. Yeah, look at the S&P took all the gains going to the Trump breakout. So that's a negative. Certainly is a negative if we confirm and close down here. But it's a positive if we start running because it will have created that wall of worry over again. But there's some other things that have also retraced the entire move. For instance, Tesla retraced basically the entire move going back. And I don't know if I have a good chart about this, but at the recent low, even Bitcoin here, and this is an ETF that follows Bitcoin, retraced almost, not quite, but almost the entire move from the Trump breakout. So these are either retests that are going to pause and refresh, or it's a negative. And again, I know I'm being a little bit ambiguous, but we're going to have to see what happens. If we see some strong moves higher, then it's going to be the pause that refreshes. If we roll over on Bitcoin, on Tesla, on the S&P, on the NASDAQ again, then it's going to be, hey, that was a warning. You got to get out. So we'll talk about it next week.
Yeah, I was going to say, it sounds like we won't have too much longer to wait to see which of those two eventualities it'll be. So we'll just, keep talking, keep our eyes on this week to week while you guys are here. All right. Well, look, we got to wrap it up here for time. John, I'll let you have the last word here. Particularly, again, like I said earlier, I'm beginning to see a heightened nervousness just amongst sort of regular investors. And we've had a lot of viewers on this channel that have been watching because they sort of have doubted the strength of the rallies that we've had in recent years, really. But I'm also beginning to see a lot of people who have been watching, who have been enjoying the ride. And have said, look, while the music is playing, I'm gonna be on the dance floor. And I'm beginning to hear them say, all right, I'm not sure if this is the time I should actually leave the party or not, or at least, start to get a lot more defensive. What do you say to those type of people?
Yeah, well, so that psychology shift has been notable. And typically, psychology can be a very bad thing. It can oftentimes cause us to do the wrong thing. But there are times where the market signals start to confirm that psychology. And we have seen that in droves. We've seen a degradation in the relative strength, the breadth of markets. Some of the leaders have started to lag. These are all negative things. We're starting to see, as you alluded to, some recessionary things start to take hold. Today, ADP numbers came out on jobs a little softer than expected. Actually, it goes back quite a ways. Actually, we've seen, one of the things that's been a big kind of nothing burger is credit spreads in corporate bonds have been near record lows. We've actually seen a very sharp, very short term, but very sharp turn up, not in a huge way, but it's a notable change. Point being is that we can debate whether I think the psychology shift is likely to lead to the so-called sell the rips rather than buy the dips. I think there is a palpable psychology change in this market. And that to me translates to, for everyday folks that maybe have been riding this wave, absolutely think about taking a step back, taking some chips off the table, de-risking, lowering your equity allocations. Absolutely. And this is the part where wrestling with regret, that is a ever-present thing in investing. You're always going to regret either selling too soon or too much or too little or too late. I can tell you from a whole lot of experience, while it might be painful to be too soon and too large, it oftentimes is less costly to your bottom line and financial security than to be too little too late. So absolutely encourage folks to not be complacent here, to not get greedy, take chips off the table, because there is very notable degradation in the markets that should be heeded.
All right. Well, thanks, John. Well said. I just want to note, I'll do a video doing a deep dive into prospect theory, which is a part of behavioral economics. But just a quick note here on top of what you said, not only, being more cautious tends to save you money in the long run, but emotionally, we as investors, we as humans, when we invest, we enjoy the benefit of a gain about half as much as we feel the pain of a loss, or said the other way, we feel the pain of a loss twice as much as we feel the joy of a gain. And so you just feel a lot more miserable if you take on too much risk that you shouldn't and get dinged for it, versus if you leave the party a little early and regret leaving something on the table. Generally, you're going to feel a lot less bad about leaving something on the table than you are about staying too long at the table and losing too much. All right. Well, look, gentlemen, thanks so much. Another great week. Folks, if you enjoyed having Kevin on the channel, would like to have Kevin come back on in Q2, please let him know by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like some help trying to figure out how to navigate this market ahead, this seemingly more volatile market ahead, if you don't have a good financial advisor who is already serving as your personal quarterback and helping you chart that course, then consider talking to one of the financial advisors endorsed by Thoughtful Money. These are the firms you see with me on this channel week in and week out. To get one of those free consultations, just fill out the short form at thoughtfulmoney.com. Perhaps even John and Mike would be the ones you'd like to talk to. You fill out that form, the firms will be in touch with you immediately. Again, these consultations are totally free. There's no commitment to work with the firms. It's just a free public service they offer to try to help as many people as possible. A reminder, too, that we have the spring conference for Thoughtful Money coming up really, really fast. It's going to be Saturday, March 15th, which should be a little over a week after the day that this video launches. If you haven't bought your ticket yet, if you buy it before the weekend, you can still get in at our last chance to save price. You missed the early bird price, but you still can get into the last chance to save price before it goes up to full price in the last week. So to get your ticket, just go to thoughtfulmoney.com/conference. And a reminder that if you can't watch the event live on Saturday the 15th, don't worry, replay videos of the entire event will be sent to everybody the evening that the event concludes. And one last reminder, if you're a premium subscriber to our Substack, you get an additional $50 off of that, whatever the ticket price is when you buy your ticket. All right, John and Mike, thanks so much, boys. Really appreciate you being here. Let's do this again next week.
Thanks, Adam. So good to be here. It was fun. Thanks for having us. And to the viewers, thank you for watching.
As always, thanks, Adam. We'll see you next week.
All right, boys. Everybody else, thanks so much for watching.
The point is, we're seeing lots of silver that is being accumulated by the central banks. That's $2,225,790,000 worth of silver has come into COMEX in the first week or so of the month. Russia, China, Saudi Arabia. Let's not forget about India, who's bought somewhere between 600 and 800 million ounces over the last 5 years. That's more than is on the COMEX and the LBMA combined. Most of the public has zero idea that there is a massive drive going on for gold and for silver. First week of September, you're seeing nearly $4 billion worth of metal stand for delivery. But this is what we've seen every single month. Now, we've always been an importer of silver, not always been, in fact, never, to my knowledge, been a net importer of gold. Both of them together signal a bigger move, a bigger trend.
Central banks are quietly stockpiling huge amounts of silver, with Russia, China, Saudi Arabia, and India leading the charge. Saudi Arabia has made small but notable purchases of silver via ETFs recently, which may signal a shift in behavior. China has bought 21 metric tons of gold so far this year, 2025. It's part of their strategy to diversify away from the dollar and align reserve assets with their global status. The notion that BRICS and other developing nations are considering silver more seriously due to its dual uses is being more widely reported. India alone has accumulated 600 to 800 million ounces in the last 5 years, more than what COMEX and LBMA hold combined. The US, traditionally an importer of silver but never of gold, is now importing both, a clear sign of a much larger global trend toward physical accumulation of precious metals. Andy, the president and CEO of Miles Franklin Precious Metals, highlights that what makes today's market different is the sheer scale of physical gold and silver being accumulated, not just by investors but by central banks, with Russia allocating it in its 2025 to 2027 budget and Saudi Arabia making ETF purchases. COMEX deliveries of gold and silver remain historically high, signaling strong demand for physical metal, while a weaker US dollar is further boosting gold and drawing silver into reserve diversification strategies. Analysts like Mike Maloney see silver poised for significant upside in a potential monetary reset, though claims of India's massive silver accumulation and extreme delivery spikes remain unverified. Experts also warn that paper metals may not provide true protection in a crisis, driving the push toward physical holdings. Andy believes the public, meanwhile, remains largely unaware of this massive shift toward physical metals. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Well, I think that what differentiates this market from anything I've ever seen, Ivan, and I've been doing this now for almost 36 years, is the amount of physical demand that is being accumulated. Now, we've talked at length about the central banks that have been buying gold. We're seeing action with the central banks buying silver. Now, of course, it started with Russia saying they were going to add it to their stockpile. First time I've ever seen a government do that. And then it mitigated moved towards China. Talking to guys like Sean Kuhn from Dolly Varden, he says, look, Andy, the Chinese, who are the second largest producer in the world, they told David Morgan they're the first, by the way, but needless to say, they're massive producers. Sean says they're flying all around Latin America, in particular places like Peru, even all the way up to Mexico, and pulling metal out of the ground before it's even called silver. They're buying doré, they're buying concentrate. They're paying double what the West will do to disintermediate the whole market, sending it back to China for refining. So you have the first or second largest producer in the world finds it significant enough to fly around the world and buy doré and concentrate right out of the ground from the miners, directly from the miners, and then sending it back to do so under the cover of anonymity, so to speak. No one really knows how much they're buying or what they're getting, but Sean can validate that is indeed what is happening. You look at the Central Bank of Saudi Arabia. Disappointing as it may be that they bought huge amounts of SLV, maybe one of the worst products I've ever seen ever in my career, because just as a side note, The short position right now in SLV is 53.97 million shares, which is it's grotesque, it's ridiculous. And remember what the prospectus said, BlackRock said, there could come a time when there's not enough silver to cover those short positions, buyer beware. But the point is, we're seeing lots of silver that is being accumulated by the central banks. What is really different to me, as far as I'm concerned, is the amount of silver that is coming into the COMEX. And, last week I jotted down some numbers. In month to date in September, the number of contracts, and this was last week, I'm sure it's much more now, that stood for delivery was 10,599 contracts. Let's do the math real quick. 10,599 contracts times each contract weight being 5,000 ounces is 52,995,000 ounces. We'll multiply that, let's just call it by 42. That's $2,225,790,000 worth of silver has come into COMEX in the first week or so of the month. And this is what we've seen over and over and over again. The point I want to get across here is that when you have countries, Russia, China, Saudi Arabia, let's not forget about India, who's bought somewhere between 600 and 800 million ounces over the last 5 years. That's more than is on the COMEX and the LBMA combined. And now you see it happening in the United States. At this level, the people don't just have the most money that are standing for delivery. Now, when we say stand for delivery, mind you, this is going into COMEX. A lot of it leaves. A lot of it doesn't leave. So regardless if it's leaving COMEX or being put into an eligible account, not registered, meaning it's not available for sale, it's going into strong hands, to this degree, these people are not only the most well-funded traders on the planet, i.e. the central banks, the commercial banks, the very sophisticated traders that can stand for delivery on COMEX to the tune of billions of dollars every month since November, since the election, but they're also the most well-informed. And I think that's the most important thing to understand, is that the people at this level who swim in circles of 9-figure monthly acquisitions are not doing things just for kicks. They're doing it because they understand where we are going. They know the playbook. They are at the highest level of information. And that's what I take away from really where we're at this moment, is that price is relevant, but price is a tool of misdirection, allowing the big money to position before all of the people that you and I call friends outside of what we do for a living talking about this stuff. The people who may be very smart, very bright, very well read, arguably just reading the wrong shit. And that's the problem. So most of the public has zero idea that there is a massive drive going on for gold and for silver in terms of delivery. Just as a side note, in the first 5 days or so, 6 days of the September contract, which is a non-delivery month, 3,626 gold contracts and 100 ounces apiece stood for delivery. So you're talking $1.5 billion there too.
Wow.
So in just the first week of September, you're seeing nearly $4 billion worth of metal stand for delivery. But this is what we've seen every single month. Now, we've always been an importer of silver, not always been, in fact, never, to my knowledge, been a net importer of gold. Both of them together signal a bigger move, a bigger trend, and that is that the smartest money in the world understands that there is a rush for physical acquisition of metal, bypassing the paper promises. So there you go. Crazy times, brother, and I think we're just beginning in silver.
Andy points out that central banks and BRICS sovereigns Russia, China, India, and Saudi Arabia are accelerating gold and silver accumulation, often buying ore and concentrates directly from miners, while the West relies more on paper vehicles like SLV. Russia confirmed BRICS talks on a new precious metals exchange with its own pricing, clearing, and auditing, reducing reliance on the Western system, while silver is gaining traction as a reserve asset, with reports of Russian buying and Saudi Arabia making first ETF-linked silver purchases. Analysts warn Western price suppression looks increasingly like misdirection, with BRICS building parallel commodity infrastructure to secure physical supply. Experts predict gold will remain strong, and silver could see outsized upside given its smaller market, though volatility and delivery bottlenecks may increase.
The only saving grace is, and maybe I would like to think they're not misinformed. See, if you and I bought SLV, we can never take possession. They can, because it's the amount that they purchased. You have to have a certain amount, and it's called a basket. If you are able to redeem a basket, which I don't know the exact amount, 20, 30, 40, $50 million worth, they can. So I'll give you an example. Kyle Bass, when he was running the fund for the Texas Teachers Union years ago, they bought, if I'm not mistaken, $1 billion worth of GLD. They stood for delivery. Saudi Arabia can do the same thing here. They do have the right to stand for delivery, and most of that metal, if I'm not mistaken, is held in the LBMA. So because they bought such a significant amount, they can stand for delivery. And maybe they had a reason behind doing that I'm not sure. For you and I, buying SLV is as dumb as a mud wall. Not only do you pay the capital gains for collectibles when you sell it, you can never take possession. It's custodied by JP Morgan and BlackRock. Of course, JP Morgan, as we have identified multiple times, paid the largest fine that the Justice Department had ever handed out at that point, $920 million or so, for manipulating the silver market. Well, and that was kind of, and the reason that I think that they got off so easily, I believe that this was done at the behest of the central bank, who gave them the green light to do this. And there are bigger reasons at play for holding down the monetary metals, but that's for another discussion. Simply to say, it was far more. In fact, you could argue that it was far more than just spooking. It was manipulation, and it was at one point thought it would be RICO charges, because in essence it's like the hitman kills someone, well, they can go after the mob boss because the mob boss ordered it. Well, the point of it is that who up the chain of JP Morgan understood this? Is it just the head trader, Michael Nowak, who was the sacrificial lamb that was put in jail for a couple of years? Or, I don't know. The point of it is that this is something that you can only manipulate a market, Ivan, for an extended period of time by pushing it in the direction that it is going. And I've been doing this for almost 36 years. Most of the time, the world didn't want gold and silver. They wanted U.S. bonds and U.S. stocks and real estate. They wanted what was, when things got scary, there was a rush to the dollar. What is happening now is that the big money around the world has become motivated, coordinated, and sophisticated, and they understand what's happening. The big money around the world largely being, when I say that, I'm talking the BRICS countries, in particular Russia, China, now Saudi Arabia, India. All of these countries understand, and they have been using the spoofing or the manipulation or the suppression of the metals market against us. In other words, hold the paper price down in the West, and then go all around the world and drain the supplies, especially off of exchanges around the globe that don't affect the price. The price is set in the West, so if you smash the price down on paper here and then buy it up there, and there, boy, that works out well. And they're smart enough to see the big picture. That's what they're doing. And then they go as far, and just ask yourself, the second largest producer of silver in the world, the largest producer of gold, don't sell an ounce. They fly all over the world and buy gold and silver in doré, which is a crudely refined bar, in concentrate, which is a byproduct of it, right from the miners, which completely disintermediates the amount and disintermediates the market and the commercial banks. They're thinking 2 or 3 steps ahead. They're playing 3D chess, we're playing checkers. So I think that this is something that is being used against us without saying so. They get it. I'll evidence it this way. I've spent a lot of time talking about the BRICS, and the BRICS grain exchange is something that is under development. And I listened to an interview about the guy who's running it a year ago, and he said, we here in the BRICS produce and consume in the global south more wheat than they do in the West. Yet we have no control over its price because that is controlled on COMEX. But with the development of the BRICS grain exchange, that will change. Now,
Wow.
They understand what we're doing with the precious metals, with the base metals. All of the things that we have suppressed for various reasons are now being used against us. It's jiu-jitsu, the premise being you use your opponent's leverage against them. And this is exactly
Absolutely.
what's happening right now, man.
Will central banks' increasing use of silver lead to a structural revaluation to that of gold? What potential effects may the establishment of a BRICS precious metals exchange have on shifting global pricing power and diminishing the importance of Western markets? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
I think that the precious metals rally is saying that inflation was much higher than what the government was publishing in terms of CPI. The gold price is reflecting collapse in the purchasing power of money. And now the gold price is probably reflecting the cost of living increases between 1971 and today, rising strongly. So I wouldn't rule out that we could have gold and silver and platinum making short-term highs in the not too distant future. Gold would be a reasonable alternative.
The recent rally in precious metals like gold, silver, and platinum likely reflects much higher real inflation than official CPI figures suggest. Since the US left the gold standard in 1971, the purchasing power of the dollar has collapsed, and gold's rise is tracking the true increase in the cost of living over time. Ray Dalio says markets risk a hard attack from rising debt costs in the US and suggests holding 10 to 15% of one's portfolio in gold as protection. Moreover, Goldman Sachs warns of this scenario. The idea is that political interference could damage trust in traditional assets and the dollar, making gold more attractive. In the near term, new highs in metal prices are possible, and gold remains a strong long-term store of value. The speaker, Dr. Mark Faber, often called Dr. Doom, is a Swiss investor, economist, and market commentator. Gold's rise since the US left the gold standard in 1971 reflects the loss of money's purchasing power and higher living costs. Markets don't move in straight lines, they surge, correct, then resume upward. Over 10 years, gold would be a strong long-term choice compared to stocks or bonds. Gold is up nearly 40% this year, outperforming most assets as Fed rate cuts, a weaker dollar, central bank buying, and inflation fears drive demand. Forecasts put gold between $3,700 and $4,000 by mid-2026. Treasuries remain debated, with long bonds seen as fragile, while short bonds or cash offer optionality. Still, gold and miners are favored amid economic and policy risks. In downturns, gold is viewed as insurance. Mark Faber specifically mentions the mining stocks like Barrick and Newmont. Barrick is streamlining by selling non-core assets to focus on top gold and copper projects, though production and regulatory risks remain. Analysts view it as undervalued. Newmont has been upgraded to Outperform for its turnaround, strong cash flow, and leverage to rising gold prices. Both miners are seen with significant upside, potentially doubling if gold's rally continues. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the video.
The gold price is reflecting the collapse in the purchasing power of money since the US abandoned or exited the gold windows in 1971, August 1971, when gold was at $35. Now the gold price is probably reflecting the cost of living increases between 1971 and today by rising strongly. That would be my view. But as you know, markets don't move in a linear fashion. They move up strongly, then they overshoot, then they correct for a few years, and then they resume their upward trend. So I wouldn't rule out that we could have gold and silver and platinum making short-term highs in the not too distant future. That I wouldn't rule out.
And
but equally, you know, if you ask me, Mark, you have to go to jail for 10 years. It's always a possibility. And then you have to invest your assets in one asset class and only one asset class. You cannot diversify. So you can choose properties, or you can choose stocks, or you can choose bonds, or you can choose gold. And you have to choose this and leave it until 10 years hence, 10 years later, when you get out of jail and want to collect your assets. In that case, what would you invest in? In stocks, bonds? I mean, I think gold would be a reasonable alternative. I mean, I've never been terribly keen about mining companies, but starting, say, about 9 months ago, I wrote that for the first time I was rather positive about mining companies because they were incredibly low compared to the price of gold, which had gone up substantially. The mining stocks hadn't gone up, but this year the mining stocks rose substantially. And I still like mining companies. I want to explain to you why I like mining companies. I think if you look at Barrick or Newmont Mining, the stocks have gone up, but they're not meaningfully up compared to previous highs. So I'd say this is a sector in the market. You asked me about value in the market, what it was desirable. I think mining stocks are very desirable. I think Barrick and Newmont, they can easily go up another 100%. I think US Treasuries is an alternative, not ideal, but say relatively favorable. And then cash is not a desirable investment, but it may be better than other assets in a downturn. You understand? You're not going to make money.
And it gives you optionality. You have optionality in case you have opportunity.
Yes. But my sense is that if everything goes down, I tell you, it will be very difficult for you not to lose money. But let's say everything goes down 50%. Like in the Depression, it went down everything 80% or so. In that case, you're the king if your portfolio only drops 20%.
Mm-hmm.
You understand? The market assets go down 80%. And you are among the fortunate ones where the asset value drops 20%.
Mark Faber points out that the dollar stayed strong until late 2014, mainly due to capital inflows, not fundamentals. Trump's policies weakened global confidence in the U.S. Meanwhile, the U.S. is in recession despite official denials. Recent analysis highlights that inflation remains sticky, with real interest rates often negative and underlying price pressures not fully reflected in official CPI data. At the same time, A weakening dollar, growing doubts about central bank independence, and geopolitical risks are driving investors toward precious metals. Gold, silver, and platinum are increasingly seen not just as profit opportunities but as safe havens and long-term stores of value. Now, let's just reflect on the interview.
The dollar has been exceptionally strong until November 2024. And it has weakened since then. And if you say, or if you argue that it was in the cards that the dollar would decline, then I agree. The dollar has been strong, but not based on fundamentals. It's been based on capital flows. In other words, the world moved capital into US assets, and so the currency remains strong. But I think Trump has done a lot to destroy to destroy the confidence people had in America. The bond market in the US should rally because we're heading into a recession. I think we're already in a recession, but of course, Trump and his henchmen will argue, no, we are doing extremely well. And the economy is exceeding expectations, and so forth and so on. But the reality is that if you look at the living standards of ordinary people, they're not doing well. No way. And the wealthy people, including myself and so forth, we benefited from asset appreciation and did very well in the last 30, 40 years. Ordinary people that have no assets, they've been hurt because the cost of living is going up much more than their salaries. So ordinary people get squeezed. And ordinary people is 70% of the US economy. There are instances where when they cut rates, the market goes up, and there are instances where it goes down, depending on the expectations that preceded the interest rate cut. But in the present situation, a 25 basis point cut wouldn't do anything. That is expected. 50 basis points, I think the bond market would react favorably, but not hugely. I mean, my view is the bond market will go and sell and trade until the yield on the 10 years is between 3 and 3.5%. Because I think the economy is much, much weaker than what the Trump team pretends it to be. Most people aren't doing well economically. Now, is Jeff Bezos doing well economically? Yes. There, say, 500 people in the US that do exceedingly well. Then another 10,000 people that do relatively well. And then there are zillions that don't do well.
Do you agree with Dr. Faber that gold is the most reliable long-term store of value compared to stocks or bonds? Could mining stocks like Barrick and Newmont really double in value if gold continues its upward trend? If you enjoy the content, Please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.
Pretty obvious that you're going to have a Fed coin. I think it's going to go to gold. It's going to drive the price really, really high. And gold's going to be one of these things that has a lot of value and it's really hard to sell. And people say, well, how is that even possible? Let's do a hypothetical scenario here. What if we saw a gold price much higher, like 5,000, eventually 10,000? That might go higher. And what you're going to see later is the reason it's going higher is because people are starting to move into it to protect themselves. Slowly bought some silver. I got a lot of silver. So now silver's like over 40 bucks. I got to go find all the silver. I can't find it all. So, and I've tried to find it all, and I look forward to selling it at some point, not right away, but I do think that it's going to go up over 50, and then people might start paying attention at that point.
Gold prices might rise rapidly to $5,000 or $10,000 if the United States eventually introduces a Fed coin, a closed-loop digital currency system. However, because the gold is not part of the official system, selling it could result in high excise taxes. Some analysis points to silver breaking its decade-long resistance, and possibly moving to higher levels $50 or more if certain large investor flows occur. Tucker points out that long-term holders may still profit when prices rise beyond $50 and probably higher. Stablecoins are now subject to more stringent regulations, including backing, audits, and supervision, after the Genius Act was passed in the United States in July 2025. This increases their credibility as competitors in the digital payments system and may lead to a wider acceptance of digital currency systems modeled after central banks. Known for his opinions on gold, silver, and the future of money, E.B. Tucker is a Resource Company board member, author, and investor. He points out that a Fed coin, a digital currency based on a closed-loop blockchain and under central control, is ushering in a period of more stringent monetary regulation. Major asset manager Amundi has warned that, given its increasing use, stablecoin regulation may disrupt international payment flows and monetary sovereignty. Gold may rise to $5,000 or even $10,000 under such a regime as people race to buy it for protection, but because it is not part of the digital system, selling it could result in high taxes. As a sign of regulatory reform, Fed Governor Michelle Bowman has called on authorities to be less wary of new technologies and more proactive in regulating blockchain and cryptocurrency. E.B. Tucker believes this shift would make gold valuable but hard to trade. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
We're walking into this system where there's going to be increasing control. And right now you have a chance to play these hope things that are going on. And you should do that while understanding that you're pretty doomed. Well, what does that mean? All right, well, you look at all this metal here. I mean, gold has done even better, right? I mean, like at some point I just switched to buying only gold because you would need like an armored warehouse to keep all the silver in. But these are things that are going to run, and then at some point they're going to be untradeable. And the gold prices, call it like 25 trillion right now. That's if you take all the gold in the world and you put a price on it. That might go higher. And what you're going to see later is the reason it's going higher is because people are starting to move into it to protect themselves. Protect themselves from what? Well, it's pretty obvious that you're going to have a Fed coin. I wrote the term Fed coin in 2000, I think 15 or something. It was way too early. Okay, that's the other problem with writing books and reports. It's a huge mistake because people, it's nonfiction writing. You should really write fiction if you want to be a writer. It's much easier to hide behind that. But I put the term Fed coin out because there'll be a closed loop blockchain. And what's going to happen is there'll be no counterfeiting, there'll be no tax evasion, and there'll be nowhere to hide if you run afoul of the monetary regime. And what's that going to do to gold? Well, I don't know, but I'll tell you what I think it's going to do to gold is going to drive the price really, really high. And gold's going to be one of these things that has a lot of value and it's really hard to sell. And people say, well, how is that even possible? Let's do a hypothetical scenario here. What if we saw a gold price much higher, like 5,000, eventually 10,000? you might end up in a scenario where if you try to sell that gold, there's this massive excise tax, meaning the gold is sort of like outside of this blockchain system that we're in. Now, to be really clear, blockchain doesn't mean Bitcoin. Blockchain means that the Fed or some new version of the Fed would because you're going to expose the Fed for what it is and have a new, much worse Fed someday. And this would be like a closed loop blockchain. So what's interesting about Bitcoin is you have this like distributed ledger. So you would just have like one ledger, with FedCoin, and it would be like centrally controlled Watson computer that would monitor every single serial number on every single FedCoin as it moved around. It'd be infinitely controllable. And then if you tried to sell the gold, you would be bringing it back into the FedCoin system, which would expose you to whatever tax rate you want. I mean, there might be like this, okay, you could sell the gold for this period at a fixed price, bring it back into the system. Does this sound familiar? Do you remember when this happened in the 1930s? Is there some eerie similarities, like a sort of like a modern day computerized FDR scenario? Okay. Yeah. And so I think when people start seeing this, they start seeing, wow, I mean, this is possible. Now, here's what blows my mind is that then they say, how can I profit from this? And I'm thinking, these capitalists, man, Lenin had it right. These capitalists will be like, they're going to hang me. Is there a way I can make some money off the rope? Do you get what I'm saying? It's like, It's like, first step is you just need to see things for, you just need to see the bigger picture. I mean, you don't have to go profiting from every sort of thing that's going to happen. But
E.B. Tucker emphasizes that the demand for FedCoin would be a response to attempts by individuals to conceal riches outside of the system, particularly in gold, rather than a result of an automatic tax deadline. Authorities may then impose severe penalties after providing a brief opportunity to legalize assets, much like FDR's gold policy but in digital form. This illustrates a larger reality. Society is fixated on money and frequently pursues it unbalancedly. The lesson is to embrace change as it comes, see the system as a game, and concentrate on living life to the fullest rather than fighting against it. Although silver trails behind gold, Tucker points out that long-term holders may still profit when prices rise beyond $40 and probably higher. Let's review the interview.
I think it's not preordained. I think the issue would happen as a reaction to people trying to avoid cooperating with FedCoin. That's what would trigger it. So it's not like they say, on this date, we're going to have this excise tax. I think if people begin hiding, trying to preserve and hide and operate outside of the FedCoin regime, then that's when you would say, okay, we have a window of opportunity for you to get legal with your gold. And if you don't get legal with your gold, you're going to be subject to like a 90% excise tax. And also like all these, different ways that you can be punished because you're naughty school children, with having your gold. We told you that's only for governments. It's only for, foreign governments, not you. Okay. So that's the type of messaging. Just see the messaging. Like I remember as a kid, when we learned about algebra, I was like, what's the point of algebra? And, my father was really smart. He was like, you got to learn how the equation works. And then you're going to see that lots of parts of life are the same equation. You'd be able to solve things in life. I didn't really know what that meant, but it turns out, he was right. So like you see that you kind of see this process. Like what's the equation of FDR? It's easy when you go back and look because everybody, that was around then as an adult is dead now. Maybe there's some people that are old that were kids then, but see the equation and forget about the emotion. And then you look at the modern scenario, the digital version of that, and you say, wow, okay, I see how people hiding in gold would make it harder for FedCoin to take effect and be a control mechanism. It's going to control your whole life, okay? So everybody in the U.S. is obsessed with money. And they're obsessed with money, and they hoard money. If you notice, people, they don't have enough money. Even people that have a lot of money, they don't quite have enough. Like the Morgan Stanley guy that I use is like, you should not stop working. Because the Tucker letter is like something I do because I love it, right? So like that guy says you should be working more. Why should I be working? Well, you could have more money. Well, what would I do with more money? Eventually I'd do something I enjoy. It doesn't make any sense. People's thinking is broken. And so you have a society that's totally obsessed with profit. I'm not going to say it's greedy because I don't think greed is bad. I also don't think money is bad. It's just that people are out of balance and they do something compulsively. And so when you back up a little bit and you see that this is where things are headed, then your job becomes different. Your job becomes to live now, to keep playing the game, but to know that it's a game and to see where it's going and to not be afraid of that, because there's no stopping where it's going, and the world definitely keeps going. And you can survive and thrive through change. 1935 is not when the world stopped. It got infinitely more exciting, and it's going to get more exciting from here. You got to go along with it. You got to flow with it, but you can have more fun when you see what's going on. And so I slowly bought some silver. I got a lot of silver. So now silver's like over $40. I got to go find all the silver. I can't find it all. So, and I've tried to find it all, and I look forward to selling it at some point, not right away, but I do think that it's going to go up over 50, and then people might start paying attention at that point. Yeah. But silver is lagging way behind, and the silver people talk about it in this way that I don't understand. It's kind of like, when someone's getting like really excited in a different language or something. I don't know what they like about it, because we're in this market where you have things like vault higher in price. And I'm like, here to $50 is like 20%. I mean, here to $100, it's like barely more than a double. And like, you can't even find all the stuff. I mean, it's like, I've got so many backyards to go dig around in. I don't know where all this stuff is, but it is fun to go out and find your stash, because, I've been buying this stuff for ages. I mean, I just bought it because I think it was cool. That's what people don't understand. Most of the time, you buy something because it's going to go up, it goes down. You buy something because you think it's super interesting, and it goes up, and I just think that, to me, I'm at a place in life where I'm like, everybody, I'm just watching what you say and what you do, and then I'm making decisions based on what I see. And it seems to me like really easy to make money.
He contends that the true difficulty lies in adjusting to a future with more stringent financial regulations without losing sight of how to survive and prosper in it. Could the launch of FedCoin hasten the devaluation of the dollar as countries look for alternatives? Will silver continue to be a secondary hedge, or will it finally catch up to the momentum of gold? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.